energy transition debate. The thing that bugs me the most is people who are trying to get us off natural gas. You know, the idea that natural gas is an enemy because it's a fossil fuel is really flawed. And, you know, ultimately all of us agree that basically we should be building nuclear if we really want to be emissions-free, because that's by far the best emissions-free option.
Paul, a couple of different conversations happening here, and I'm trying to reconcile them. You've got this $80 price target, or at least an $80 call that you're looking for oil prices to gravitate towards. Then we're talking about a problem right now that could be fixed in a couple of weeks as we get into spring. So, Paul, can you reconcile the two things for me?
Yeah, I mean, the demand growth that we expect to see is going to be about 3 million barrels a day into summer. You're about 5 million barrels a day versus last year in OPEC, with another million coming off from Saudi. So that leaves you about 3 million. At the same time, we've been drawing inventories before this crisis at about 2 million a day globally. So basically, the market is pretty much tight by summer, and that gets you. And that's, by the way, I mean, I'm sure you guys, you know, are pretty jazzed up about the potential for a major pent-up demand situation to emerge here. I think all of us, you know, are desperate to fly on a plane and do whatever Tom does in his summer vacations, but I'm sure it involves travel. And you know, so the point is,
count me out, Paul.
The point is that you're going to see a significant upsurge in demand. It's almost guaranteed. This is always, you know, energy-wise, this is a very strong point, obviously, for winter fuels, so obviously natural gas, heating oil. Propane, by the way, is pretty much approaching crisis levels as well. The line that we've had before this crisis was there's no propane west of the Mississippi. So my point is that you're in an energy crisis, and I don't even see it as the top headline, you know, in the various media outlets that I follow, including Bloomberg. Bloomberg always does a great job, by the way, on
Thanks,
energy.
Paul. Thanks for clarifying that. Just to jump in, Paul, just quickly.
Some of the more populist outlets don't seem to realize that you've got an energy crisis unfolding right there, a la Katrina.
Paul, final question from me, sir. There is a difference between a rebound in crude prices and the start of a commodity super cycle, and I think that's been the big conversation amongst many people in this industry in the last couple of weeks. This was Andy Hall, of course, famed oil trader of the previous cycle, the last super cycle. He said the following in the FT: the oil and gas industry is in terminal decline. Perhaps this dead cat can bounce a few more times, but would that be a super cycle? What's your take on that, Paul?
Well, yeah, I used to meet Andy in a bar up on the Upper West Side.
Here we go.
Piano player, and he's obviously a brilliant man. Always bullish, actually. I'm very interested to hear him not so bullish. Yeah, my concern is obviously it's a consensus call. There's going to be a super cycle. You know, the world and his wife is saying, yeah, you know, everything adds up here to a super cycle. Having said that, we are bullish on oil demand over the next 5 years. You know, the whole impact of EVs, which is so heavily discounted by the market, overvalued by the market, is going to take a lot longer to really have an impact. And it really comes down to us still being at 95, 96 million barrels a day of oil demand, with effectively no jet fuel demand in the US you know, at a discretionary basis. So you can easily get 3 to 4 million barrels a day of extra jet fuel demand here, which takes you way back up to the 100 million barrel a day market. And then you're really questioning, can the supply side meet that? As you know, the key questions, one of them is going to be, is the US E&P industry going to actually show capital discipline and generate returns this time? Yeah. That's what's exciting to me. I think they will. And yesterday we had Devon announce a variable dividend very early in its announcement of that policy. So essentially now Devon Energy is paying a standard dividend and then a variable dividend depending on the oil price. And they came in with a 19-cent boost to their dividend just based on $45 oil in Q4. That's a very good leadership role from Devon to what this industry should be doing, which is paying out heavily cash to shareholders to pay them for the ESG pain of owning oil.
I'm far more interested in how drinks went with Andy on the Upper West Side. Was this 2007?
He dresses like Steve Jobs, right? So he's a mysterious figure. I don't know if you've ever seen the naked painting of him and his wife, but I've seen him naked.
This is taking a real interesting turn.
6:40 Eastern. We're going to catch up, Paul. Don't leave it there. We're out of time. Paul, good to see you, mate. Paul Sankey of Sankey Research. Thank you. What just happened then?
I have no idea. Naked pictures and drinks. And
Brent 64, WTI 60.
Look at those markets.
Just look at those markets.
The pictures look great on radio. That's what I can tell you.
I bet they do.
Tom, you just go right there, don't you?
Yes,
I bet they do.
Yeah, it's effortless. Yeah, I liked how he had me for my summer vacation on the Gulf Stream. And John, what's great here is we all know Lisa's going to be in an 18-foot Grumman canoe, you know, floating around the Adirondack.
Where's she go? Oh, right. Okay.
Right. doing lots of portaging. And Tom, I know you're jealous. You'll give me all sorts of tips
Yeah.
and boot suggestions as well.
I would. What I learned there, which is really, really important, John, is we're all getting used to where oil's going to be. And the answer is Ed Morse, Paul Sankey, Jeff Curry, and the others are saying range bound and higher. That's a whole new world.
Jeff
after
Curry's
all.
talking up 80. JP Morgan not ruling out a move towards 100.
Yeah,
And
it's
as
like, hello.
Paul points out, the conversation around a commodity super cycle, Tom, is really taking off again. And to his point, what we saw last time was not discipline on both the energy side and the mining side as well. What we've seen in the last 5 years has been a lot of discipline. Does that discipline stick?
Can I just break
if
in
commodities
one-
shift higher even more?
We don't have a choice. You're going to break in whether we like it or not.
There's something
Continue.
really interesting that some of the big oil majors are actually cutting production over the long term. And John, to your point, how much discipline can there be to maintain that if prices go up to $80 a barrel?
We will see. Alongside Lisa Bramett and Tom Keane,
What was
I'm
that?
Jonathan Ferro. That was just me getting to the break. Coming up next, Lawrence Sauer, Johns Hopkins Associate Professor of Emergency Medicine from New York City this morning. Good morning. We've got two people now in this show that just want to cut in all the time. S&P 500 futures down 2. This is Bloomberg.
With the first word news, I'm Karina Mitchell. That deep freeze could keep parts of Texas in the dark for days. Power suppliers from Texas to North Dakota implemented rolling power cuts for the second day in a row. The operator of the Texas electric grid says it could be days before enough power plants are back up and running. On Tuesday night, outages spread to Arkansas, Louisiana, and Mississippi. Meanwhile, the U.S. and Japan reportedly have agreed to extend their agreement on troop funding for a year. According to the Asahi newspaper, the deal will keep Japan's share of the cost of hosting U.S. forces at about $1.9 billion a year. Former President Trump had demanded a fourfold increase in financial support. And there is no love lost between Donald Trump and Senate Republican leader Mitch McConnell. The former president blasted McConnell in a statement, calling him a hack who was responsible for Republicans losing the Senate. Trump said the party can never be respected again as long as it has leaders like McConnell. After the Senate acquitted Trump in the impeachment trial, McConnell said the former president was responsible for the riot at the Capitol. And Ford plans to go almost entirely electric in Europe by the end of the decade. That's a major overhaul for the automaker. Ford didn't sell a fully electric vehicle on the continent last year. The company is putting $1 billion into a Germany factory that will start making an all-electric model in 2 years. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries?
Okay, guys, I'm going to place a stop on profit. So if you followed my trade and purchased Japanese yen, there is the chance to make a profit. So I'm placing a stop on profit at 105.997. Okay, just right here. Okay? So whatever happened, you're already in profit.
Women a fair run for leadership. Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
We have now, by the end of July, we'll have over 600 million doses, enough to vaccinate every single American. We got them to move up the time because we used the National Defense Act to be able to help the manufacturing piece of it to get more equipment.
Making more progress. The President of the United States, Joe Biden, there speaking to CNN. From New York City this morning, good morning. Alongside Tom Keene and Lisa Bravitz, I'm Jonathan Ferro. Your price action shaping up as follows this morning. We pulled back just marginally on the S&P, down 2 points, 39.26 on the S&P 500. In foreign exchange, Tom, dollar stronger against pretty much all of G10, with the exception being Japanese yen. Euro dollar back to 120.62, down a third of 1%.
And John, I just looked at renminbi. Granted, the Chinese New Year in the way of that, but the Chinese yuan is very well contained and really indicates stronger yuan. John, it's like sort of like $80 oil. I'm not sure we're really prepared for a new bout of yuan strength.
Are we prepared for $80 crude together with yields approaching
strongest feeling
150? Say. Just throwing that out there.
The only one who's prepared for it's Lisa, because she had 2 oil drums at a negative $22 or something.
There's a trade.
And I'm in a gloomy barrel, so there we go.
Well, that's what we like, folks. Paul Sankey with us there. Thrilled that he could join us. And, of course, Nora Rubini scheduled on Bitcoin. Right now, the conversation of the day on the pandemic, Lauren Sauer with John Hopkins. I know Lisa and John got a bunch of questions. We welcome all of you across this nation on radio and television. Lauren Sauer, estimate for us the amount of your public that doesn't want to get the vaccine. Is it inconsequential? Is it tangible?
I think it's definitely tangible. We're rolling out to healthcare workers and elderly and vulnerable populations right now. I think around 1/10 of the population, maybe even less, has been vaccinated so far. But what we know is that we're already seeing hesitancy from these vulnerable and marginalized populations, and that's within our healthcare cohorts and more broadly as we're starting to roll out vaccine education campaigns and access campaigns. And so we don't have great numbers on the percent of the population that's saying no, because there's so many people who are willing to get it right now just because they want life to go back to normal and they're not scared of the vaccine or they're not hesitant to get it. But as soon as we get to the point where there's a significant amount of supply increase and we've gone through our frontline healthcare workers, we've gone through our elderly populations that have been able to get it through things like long-term care facilities, a lot of us think that we're going to see a sort of a cliff where there's this drop-off of people who are willing to get it, and we're going to just be sitting on supply.
Lauren, as you talk, it just strikes me that this process has been really messy. I mean, we're dealing with both the education campaigns in addition to trying to figure out the rollout campaigns, because it's changing in real time with the CDC recommending possibly delaying the second shot now to get the first shot in as many people's arms, to John's point, following the UK model. Lauren, is this a mess? Is there a plan? Do you think that we're moving ahead as expeditiously expeditiously and as organizedly as possible. I will get my words out.
Yeah, I mean, I think there's a plan being built, right? But it's being built, as it's going. And that's really problematic for something like this, where you potentially have multiple vaccines with multiple different distribution strategies, multiple different cold chain processes, and multiple different dosing approaches. And so how this has been rolled out has been left to local planners. And those are the same people who have had to plan testing campaigns, who have had to plan PPE access projects, who have had to do all of the case counting in their region, and there's just not enough local resources to do that. The national strategy is being fixed, and by fixed I mean built, I think, because we didn't have a strong national strategy for vaccine rollout. It's been incredibly impressive how fast we've gotten to vaccine, but that is just one piece of the picture, the actual product. And then all of these other pieces, I think, have been neglected while all of the focus was on getting vaccine that actually works. And so now it's time to really focus on a strategy that takes all of the responsibility out of the local health departments and local health systems' hands, so that they can go back to providing strong patient care and planning for all of the other day-to-day emergencies that they have.
In the meantime, President Biden last night at a town hall meeting said that he expected things to be back to normal by Christmas next year. What's the earliest that you see as plausible?
I think that the first thing we have to do is readjust our sense of what back to normal looks like. I mean, this is a virus that's going to be with us for a long time. We're not going to get rid of it. We are going to manage it, probably the same way we manage flu, but there are some distinct differences. And so as vaccine rolls out and more people get it, and we do focus on these education campaigns, we're still going to have to maintain our masking strategies, maintain our social distance strategies, probably well into the new year, I would say, and possibly more if we don't spend a lot of time talking to these communities who are hesitant about vaccine right now.
Lauren, we keep hearing from several sources, including yourself just then, that the national strategy to roll out this vaccine needed to be fixed. Just looking at the numbers right now, the average daily rate of 1.67 million is good and better compared to where it was when Joe Biden took the presidency and walked into the White House. But it was approaching 1 million then. What was wrong with the strategy then, and how has he fixed it? What's he changed?
I think there's a couple of things that are happening. I think the more vaccines are coming online. People are getting messaging from their highest level public health leaders, which is absolutely critical. We were in a sort of trusted messenger gap, and that is a problem when people want information. It's okay to say what we know has changed. It's okay to say we have more information than we did a week ago, but fundamentally, if you're not hearing from a consistent, trusted voice, you can't build any of these strategies to sort of fix what's happening in this pandemic.
Lauren, we appreciate your time and thank you for joining us. Lauren Souther of Johns Hopkins on the more coherent message in the last month or so around the vaccine rollout. Just to repeat that number, Tom, 1.67 million doses per day in the past week. That's your daily average in the United States.
It's building up. I mean, it's a day after day thing. I'm really into the day after day slogging forward. Granted, the weather in the Midwest really hasn't helped at all, John. But with that said, it's about what was lost. And I don't want to do a big look back, but we had a year or two, well, not a year, we had till March of last year, basically a non-education on the efficacies of vaccination. We had that 40 years ago. We had that 50 years ago when they put the pink drops in my mouth for polio.
Tom, you mentioned the cold snap. Lisa, you do wonder whether that starts to weigh on the rollout in the next couple of weeks.
Well, we've already seen that. I mean, basically, it's disrupted both people going out and getting the vaccine, but also the storage of the vaccines has been also disrupted, causing there to be some waste. And this does raise a question. How long will this go on and how much this will slow the effort, John?
12.2% of the U.S. population have had at least one shot. 4.7% are now fully vaccinated, including a certain Tom Keene.
Yeah, you know,
vaccinated.
I'm gonna make it real quick, John. It's great. It was great. It was a great experience. I understand how fortunate I am, but we have to jumpstart this without fear and a belief in the science of it. I feel great.
Good. I'm pleased you feel great.
How great do you feel?
Lisa and I are waiting for our turn.
I got to check the temperature in Fargo. Hold on.
Please go do that. You've got the energy to do that.
You take your time.
I feel great.
You take your time. Up next, Dean Kerner, Macro Risk Advisor, CEO from New York. This is Bloomberg.
Great. No celery, please. No celery.
We closed position on Japanese yen, as you can see. I'll show you where, just right here. Well, you know where it is, because if you place an order, you're automatically being filled with this order. So basically, you got already profit, right? So it took us how long? Let's see. It took us a couple of hours. We placed an order just right here at about, 10:15. And right now, 12 o'clock, 2 hours. You already made a profit. Well done.
Going to be a global recovery if it happens, for the simple reason that it was a global recession.
The hope is that we see this unleashed pent-up demand lift us even higher.
It is inflation that will ultimately drive the shift in monetary and fiscal policy.
We're still in the depths of the crisis.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Bravitz, I'm Jonathan Ferro. In the last 24 hours, the big story is in the bond market. A clean break of 120 through 125, and then overnight, Tom Keene, through 130.
Yeah, there's no question about it. The bond market's a big shift, and the non-correlations here. As I said earlier, it's an odd data check right now, John. What I would say, we got Nora Rubini coming up later on Bitcoin. And coming up next, our most important conversation of the week on the odd.
Not just a treasury market sell-off, it's a global core government bond market sell-off.
Yeah, and you're seeing this even more in the U.S., but as you said, around the world, this belief in the reflation trade, this idea of everybody piling back in, going out, flying around, getting back to normal. And this is all fueled, we haven't emphasized this enough, John, the idea that we actually are seeing the cases decline substantially across the United States.
Vaccines up, cases down, the outlook improving. Here's the price action this morning. Equity futures pulling back just a little bit on the S&P 500, down 2 points on the S&P, negative not even a tenth of 1%. TK mentioning the dollar strength this morning against the most of G10. You see it right there. Euro dollar 120.62, off by a third of 1%. There's the pullback in yields. Yields up, then in just a little bit, down 2 basis points to 129 on the US 10-year. Got to get used to seeing that. Really struggling with that.
I agree.
129
Totally
on the
agree.
10-year. Had to double take and think, was that euro dollar? It is not. It is the US 10-year, Tom. Huge unwind over the last couple of weeks.
And some dollar strength as well. I think it's interesting to see dollar yen back to a 106 level, and you see that with euro yen showing stronger euro versus yen, John, and that's unusual.
Crude picking up as well, north of 60 on both Brent and WTI. We do have an energy crisis in the United States of America, and joining us on that is Rachel Adams-Heard this morning, Bloomberg energy reporter. Now, I've been told, Rachel, that you've got some energy problems yourself. The power is down, so we'll be ready for any technical issues. Just walk me through how things stand right now where you are.
So ERCOT just said that they are restoring power to homes, but it's moving slowly. There's still over 2 million people in Texas alone that don't have power. I'm looking out from my apartment, and pretty much as far as I can see, there's no lights. Even downtown, it had been lit up until last night, but it's dark at the moment. So it definitely seems to be, at least for some people, to be getting worse. They're trying to rotate the blackouts now, so the folks who didn't have power for the first half of the week might get theirs back for the second half, and then those who did have power are likely to see outages going into the weekend.
Rachel, stay safe, won't you? And thanks for touching base with us. Stay close as well. We need to catch up. Rachel Adams-Heard there on the latest in this energy market across the United States. For crude in the commodity market, for market participants, Brent, $64 a barrel. Tom, WTI, approaching 61 now.
Yeah, and that Paul Sankey conversation of the last hour, folks, across our 3 hours was critical. John, I was surprised how Mr. Sankey didn't mince words. He said this is historically one of the 2 biggest oil outages globally ever.
And even beyond this, looking for a move to 80, potentially on crude. Yeah. Likewise, Jeff Curry of Goldman Sachs as well. Tom, we need to do what you mentioned at the top of the hour. We need to do a clinic on the VIX, and I want to bring in Dean Kernan, Macro Risk Advisors founder and CEO. Dean, I want to start right here, the VIX. I think many people in the media often refer to this as the fear gauge, which implies it has some kind of negative correlation with risk assets in the equity market. Dean, can you walk us through why the VIX is not just the fear gauge and what it actually is?
Yeah, so certainly the VIX is negatively correlated to the S&P. We see the S&P fall, the VIX rise. So that correlation, negative correlation's been around since the inception of the VIX, some 30 years ago. What's different right now is that the equity derivative markets, which are, like all markets, governed by supply and demand, you have sellers of optionality and you have buyers of optionality, is one that is vastly undersupplied. What do I mean by that? A couple of things are going on. First is, right around a year ago, as things started to heat up and through March, the explosion of volatility in the S&P 500 imparted huge losses to strategies that had banked gains for years. And those are effectively ones that harvest the premium of selling volatility over time. These have done very well, and good, effective strategies tend to invite capital. So people were very big into this short vol trade, and a lot of that capital got wiped out. It's still recovering. So you have, in some ways, this supply shortage in terms of people that are able to sell volatility. And then alongside that, as has been talked about for a long time now, is the Reddit phenomenon, the retail phenomenon, which is a lot of things, but one of them is a voracious source of demand for optionality. These folks have learned enough about options, perhaps by watching TD Ameritrade commercials and using trading technology that gets them instantaneous executions. They know enough about options for sure to buy them. And they're all buying very short-dated call options on single stocks, on on indices as well. And so you've got this supply-demand imbalance, less supply, more demand. And so in addition to being a fear gauge, the VIX is also representing this imbalance. And it's clearing the market at a very high level relative to just about anything we think it's related to as a function of this supply-demand imbalance.
Beautifully explained, Dean. And you talk about the non-correlations here to cross-asset, how odd this moment is. For our listeners and viewers, can the VIX be used to determine a great bull market right now? Or is it so messed up in the derivative space, it's not the tool it was a year ago or 10 years ago?
Well, it's valuable. It's tradable, which is important. You can use it for risk management purposes. So it's not just a metric that we calculate and follow religiously, but it is an instrument that you can use for both offensive and defensive purposes, both through futures on the VIX and also through options. But as I alluded to, Tom, it's dislocated versus other metrics. So you've got to be careful in terms of the read-through. One of the things that caught my eye is as Mario Draghi takes over in Italy, he's pulled off this bond issue for Italy. $10 billion, 10 years, 65 basis points. The demand book was 110 billion, euros. So more than 10 times oversubscribed at 65 bips for Italy for 10 years. It just shows you that on the bond side, folks are tripping over themselves really to survive in taking, all kinds of credit risk across the spectrum. And so it's very different, even as taking credit risk and taking volatility risk are similar, these markets are really reacting to very different supply-demand imbalances right now. So you do have to be careful in terms of the read-through on the VIX.
Dean, there's a larger question that's embedded in what you're talking about, the sort of untraditional inputs that are pushing the VIX higher, that are pushing bond yields lower, and it raises a question about hedging your portfolio, where a reliable hedge is, what is the buffer, and how would the VIX factor into that if bonds perhaps are not the buffer they have been given how low yields are?
Yeah, it is the question right now. And typically you've got three sources of defense in your portfolio, in addition, of course, to just running smaller in terms of, how long in the market you are. You've got three things. You've got hedges, which, as we've been saying, are expensive. The VIX, by all counts, is high relative to the volatility in the markets and to other metrics we think it's related to. Diversification, very challenging, right? It's very easy to get caught up in some correlated unwind, a factor unwind. We just saw this whole GameStop saga induce a lot of volatility on the market. And then, Lisa, as you mentioned, duration, owning bonds as a hedge. It's really difficult to get excited about that process. In fact, you're losing money owning bonds, right? So this was, for years, a positive carry hedge. You earned a coupon, and on the days when the market went down, the bond market rallied. So you got both positive return and a negative correlation. That asset is improbably difficult to find, and I would just argue it's over. The tailwind that has been the 40-year bull market in the bond side is done, and so it really begs the question what to do. And it's at a time when valuations are very stretched. Investors really, I think the nervousness that you hear is this collective, this market could really ramp up. As I thought Druckenmiller's comments recently were just, they really hit home for me, which is we are about to throw a gigantic amount of stimulus, as Larry Summers really laid out well, on a market that's about to reopen anyway. And so it's really difficult not to be involved. And I listen to people, who allocate money for a living, and I just see the challenges. It's very difficult not to be along for this, but it's also very uncomfortable, and there's no obvious offset. There's no obvious defensive play. They all seem expensive or difficult to access.
Those two words, it's over. Dean, we've got to have this conversation soon and quickly. Dean Kernett there of Macro Risk Advisors. The days of having that uncorrelated asset, that asset that provides you with those risk mitigating characteristics, as Mohamed Al-Arian would always talk about. Tom, two words, it's over.
Well, the mathiness is just there. I mean, it's all uncorrelated. And again, I'm going to go back, John, to what I see in the Bloomberg. We're here in our studios with the terminal, and it's real simple. It just shows me an oddness right now that's substantial. I mean, I'm waiting for BitDog to print 52,000. You talk about odd, and we'll get to that with Rubini. But John, what Dean said there about the VIX as a clinic, people are going to have to go back and re-listen to that about how odd we are at 21.49.
I totally agree with you, Tom. And Lisa, just to put a bow on all of this, if it is over, what does that mean about how much risk you do want to take?
Well, and it shows that that's the reason why risky assets are not treated as riskier than, say, safer assets, because things have been turned on their heads. I mean, you've actually seen riskier debt outperform because it has a higher cushion against losses, and you're seeing safe treasuries lose value.
We've got a lot to talk about this morning. As Tom points out, coming up in the next hour, 8 Eastern, Nouriel Roubini, Professor of Economics at NYU Stern School of Business, on Bitcoin. Bitcoin absolutely flying so far over the last year. From New York City this morning, good morning to you all. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Karina Mitchell. Utility operators struggling with that deep freeze in Texas have a warning. Rolling blackouts could keep parts of the state in darkness for days. Power cuts were implemented for a second day in a row to help prevent the collapse of electric networks. Outages spread last night to more states, including Arkansas, Louisiana, and Mississippi. Meanwhile, total U.S. oil production has plunged by the most ever because of the unprecedented cold blast. Traders and industry executives say crude output is down by about a third. In America's biggest oil field, the Permian Basin in Texas, production has plummeted by as much as 65%. And President Biden says he has invoked a federal law to speed up production of the coronavirus vaccine. The president told a CNN town hall meeting that Moderna and Pfizer agreed to sell more doses of the vaccine to the U.S. faster than planned. Last week, the government announced there would be enough doses by the end of July to inoculate all American adults. And another day, another record high for Bitcoin, the world's largest cryptocurrency, scaling another peak, rising almost 6% to break the 51,000 level. Bitcoin has risen fivefold in the last year. Activity in Bitcoin futures suggests traders don't see a sudden end to the crypto rally. Global news 24 hours a day on air and on Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
igual que los demás países del mundo, no están preparados para esta pandemia. Más aún, los más afectados son los países de desarrollo como el nuestro, ¿no?
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
The Fed can't actually give people jobs. And the tools that the Fed have affect the macroeconomy in general, whereas the problems we face are much more narrowly focused. But what the Fed can do is not get in the way of that recovery, and that's clearly what they're intent on doing.
Lou Alexander there, Nomura chief US economist, talking up the recovery and what the Fed can and can't do. From New York City this morning, good morning. Alongside Tom Keene and Lisa Bravis, I'm Jonathan Ferro. Here's the price action this Wednesday morning, shaping up as follows. Equity futures on the S&P 500, marginally lower, a mild move, a point or two, Tom. Down not even 1/10 of 1%. In the bond market, we had a little look at life above 130 on a 10-year last night. 129.56 is where we are right now, coming in a couple of basis points. And foreign exchange, euro dollar, no longer with a 121 handle, back to 120. Tom King, 120.59, we come in 0.4 of 1%.
Yeah, dollar's really where the movement is today. And of course, oil, we've done a lot on that with West Texas Intermediate now rounded up to $61. And you wonder, Brent crude 65 and higher, how that will change perceptions. Right now, there's lots going on here. Kevin Cirilli joins us from Washington, our chief Washington correspondent. Kevin, I'm going to assume the honeymoon is over, and maybe the honeymoon is so over. What does your Capitol Hill look like with the honeymoon over?
Well, it's actually returned to some sort of normalcy. You know, we've got the GameStop hearings set to begin, and I think that the focus is about 10 to 15% of staff on Capitol Hill has returned to office. It's a very somber mood, but really, as you mentioned, a return to normalcy, an adjustment of sorts. But there's still a troop presence. But for the most part, things are getting relatively back to normal.
Yeah, okay, things are getting relatively back to normal. What does that mean for you in terms of getting legislation done? Is it a gridlock? Is it a new kind of gridlock with Democrat, Democrat, Democrat?
Well, you know, I think that the two main issues shaping this week's conversations from a policy level are obviously the stimulus talks that are continuing, and I would anticipate that gets final signage sometime within 3 to 4 weeks, Tom, on President Biden's desk. But secondly, look, energy and infrastructure as a result of the Texas blackouts. And I think that there has been a conversation about the need for infrastructure in wake of what's going on in in Texas. Yesterday, I spoke with former Energy Secretary Dan Brulette of the previous administration, who even said that he believes that more infrastructure spending is going to be needed and that there are some Republicans who would be willing to get on board with that. I talked to other Republicans who say they're very wary of any more spending, especially if it comes after the stimulus talks. But then energy, and I pointed to this yesterday, but yesterday, following Bloomberg surveillance, I did speak with two sources in the offices of the four centrist Democrats in Texas who wrote to President Biden and said to back off some of these energy policies. And look, and based upon my reporting, I can tell you that those conversations are only going to become more public. And also with the new Energy Committee chairman in the Senate, Joe Manchin, ready to take the gavel of that committee, it's definitely going to become a much more loud conversation about the divide in energy policy, especially in states, for example, like New Mexico, where you've got some Democrats who are up for some tough re-election fights.
I love the first response there, Kevin, that things are getting back to normal. The former president just called the Senate Minority Leader a dour, sullen, unsmiling political hack, and things have got back to normal, have they?
You know, the only thing not abnormal about that is that it was done via a statement and not via Twitter. Look, I can tell you that based upon my reporting, I've spoken with two sources close to former President Donald Trump who tell me that he is carefully eyeing and weighing whether or not to inject some of the Trump political machine into a potential California governor runoff election. You'll note that there are a couple of weeks left for the signatures to be gathered for the tally of a potential California governor recall election. Governor Gavin Newsom, a Democrat, has faced incredible criticism, not just from Democrats, but obviously from Republicans as well. If you're looking at California, that signature threshold will have to be reached by mid-March, and then following that, in about 60 to 80 days is when that recall election would come. From a policy prescription menu standpoint, Silicon Valley, big tech, energy policy in the auto sector. This is really potentially ground zero for a bellwether state of sorts for Republicans and Democrats as they head into the midterm elections.
Meanwhile, sooner than that, there is a question of when we can actually start to get back to normal. And Joe Biden last night was talking about this Christmas possibly getting some sort of normalcy back. He also talked about getting kids back to school by April, clarifying a position that his administration has had. How close are we to actually getting kids back to school? And do we have a sense of what the Biden administration's plan on that is?
When I talk to Democrats, Lisa, they point to just how much of a complex issue education is for the Democratic Party, because they're weighing, obviously, the want and the need to get students back into the classroom in a safe and responsible manner. But they're also weighing teachers' unions. You look down in another battleground state like Florida, where DeSantis has really rise to the top of 2024 chatter in terms of longer-term political ambitions, and he's done so by making education one of the top issues that he's talking about. Education remains something that top health officials, including Dr. Fauci, have discussed openly in recent weeks. But education and getting schools reopened safely is a very local issue. But now it's really penetrated the halls of 1600 Pennsylvania Avenue.
Kevin, just quickly, let's finish on this. You mentioned the midterms and some of these officials who have to face an election in the next couple of years. This is what the president went on to say: "I will back primary rivals who espouse making America great again and our policy of America first." Now, I'm trying to understand what that actually means, because outside of supporting or showing support for the former president, what are the policies that he wants to see?
When I talk to a source down who frequently talks to the former president down at Mar-a-Lago, look, three things. First and foremost, primary with the super PAC against those Republicans who voted to impeach him. Secondly, election integrity, albeit in a very different way in states at the state legislator level, not necessarily at the congressional and federal level. And then thirdly, California recall. I can't stress this enough. I mean, you got to, candidly, whether it's Rick Grinnell, the former acting director of national intelligence, or a couple of Republican mayors out there, this is shaping up to be a massive bellwether election where you could have the former president holding rallies in California. And he's weighing that. And I can tell you that, I can report that. I mean, he is weighing holding rallies in California over the next couple of months. It's not that complicated. He is not going to change, and he is going to continue to play a role in the Republican Party, as that Politico Morning Consult poll that came out yesterday showed. 53% of Republicans want him to play a role in the party.
Kevin, good to see you. Kevin Cerruti, Chief Washington Correspondent and host of Sound On Bloomberg Radio, weekdays at 5 p.m. Eastern. Tom Keene, we're about to see more of the same.
The politics continues. Exactly. We just continue on. That's all there is to it. What are we? We had an election, 6 weeks ago? Done. Gone.
Something like that.
Next.
Something like that. Coming up next, later, Patrick Armstrong, Plurimi Wealth Management CIO. Looking forward to that from New York City this morning. Good morning. This is Bloomberg Surveillance live on Bloomberg TV and Radio.
very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast, and it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
From New York City, this is Bloomberg Surveillance live on TV and radio for our audience worldwide, counting you down to the opening bell, about 2 hours away. Here's the price action. Equity futures come in marginally. We come in by about 2 points on the S&P. On the Nasdaq, down by 0.2%. On a Russell, down by about 1/3 of 1%. Switch up the board. I want to get into the story of the last 24 hours. 3,900 is your year-end price target over at Morgan Stanley and Mike Wilson. They're sticking by it. What they're looking for is massive churn beneath the surface, and this contributes to that. Your 10-year yield intraday right now, 129.89, coming in about a basis point. Crude 60.95. I think year to date will tell you a bigger picture though. Crude higher, rallying, yields up. What does this mean? It means these two sectors have been absolutely flying. Let's finish here. I want to talk about energy, I want to talk about financials. The read across from crude to energy, obvious. From the bond market, 2s, 10s, steeper. The banks like that. The financials up by 14% on the much followed KBW Banks Index. And Tom, look at the energy sector. This is year to date. Had a 20% move on S&P 500 energy names. Just absolutely unreal, Tom, year to date.
And you take where the weighting is of energy in the broader indexes right now, and a corrective just back to normal is a heck of a rally. That's a heated debate, I would say, John.
And that's why some people think this can continue, that maybe you get this range-bound S&P 500 in the minds of Morgan Stanley, but beneath the surface, you get this massive churn. That's the cross-asset story. Let's get to the stock movers this morning and say good morning to Romain. Hey, Romain.
Hey, good morning, John. That's some dramatic music there. Let's start off, of course, what's been going on in the oil space here. We talk about not only the shutdown in U.S. oil production, right now shaping up to be probably one of the biggest disruptions in U.S. energy supply, at least in a non-wartime era. Chevron here, of course, actually benefiting, at least in the short term here. They've, of course, shut down production completely. Pretty much the entire shale industry right now is dark at the moment. So you're seeing bids come into those stocks. It'll be interesting to see how that plays out over time once we start to get those dislocations relocated. Hilton actually out with earnings. And interesting, remember, Hilton had actually benefited a lot during the summer because, remember, a lot of their locations are in locations where people could drive to. So they actually saw a pretty decent uptick in demand in the summer. That sort of petered out in the fourth quarter. Revenue per room available dropped about 59% in the quarter. More importantly, they actually reported a surprise adjusted loss. The street was looking for profitability there. So some concern here about the trajectory of Hilton Hotels. And John, I know you love to hate on anyone who loves video games, but the 13F filings that just came out showed one big fan, the Prince of Saudi Arabia, Mohammed bin Salman. Apparently, Riyadh and the big public investment fund over there investing about $3 billion in Take-Two, Activision, as well as Electronic Arts. A huge play here in the video game space. And apparently, a lot of this shouldn't be a surprise. He actually gave an interview to Bloomberg back in 2016 where he talked about his affinity for video games and how he'd like to see more investment in that space. Flip up the board here. We can take a look at Shopify, biggest Canadian company out there, also reporting earnings today, and they pretty much knocked it out of the park. Gross merchandise volume doubling in the most recent quarter. A lot of people now concerned here about whether they can continue this pace of growth. Obviously, a huge beneficiary of the COVID shutdown. Keep an eye on Quantum Space, of course, a maker of these multi-layered batteries for EVs. This is a huge deal here. They finally showed some proof of concept last night that these things could work. This is basically going to be a safer, cheaper, and potentially longer-lasting alternative to the lithium-ion batteries that are now popular. They still have a long way to go to actually get these things made, but if they do, going to be a big deal. And MicroStrategy, interesting move here. Remember, they made about $1 billion in purchases of Bitcoin over the past 8 months or so. Now MicroStrategy is coming back saying he's going to borrow $600 billion in convertible debt, basically to use that to add more Bitcoin to the balance sheet. Of course, this all comes with Bitcoin right now trading at an all-time high. That's known as the what?
The Pharaoh strategy.
By the way, Romain, you came on with boxing gloves today. Dramatic music.
Yeah, there was. This is a very dramatic show. I like it. The new color scheme, the new set. John's moving around. Does Tom ever get to walk?
No. This is not. No. Don't even go there, Romain. Don't even suggest it.
All right.
Are you done?
I could stay if you want. I think you have a guest, though.
Well, we've got Bitcoin. We've got Nora Rubini coming up later. Romain Bostic, thank you so much. The close, look for that this afternoon as well. Right now, Patrick Armstrong with us, Plurimi Wealth Management. He writes acutely interesting notes linking in economics, finance, into actually the running of money. Patrick, I love what you wrote about the real yield, the inflation-adjusted yield, where it is rising, but it is so negative right now in the United States. What's the requisite real yield? What's the hurdle rate for you where the real yield really begins to move the markets?
Well, it seems to be a bit of a status quo right now, where yields are rising, but inflation swaps are rising by similar magnitude. So for the last week, 10-year yields have risen a little bit more quickly than inflation swaps have. But if we're at -1%, that's just a risk-on signal. If we're at -0.5%, I think that's still a tailwind for risk assets. So we're still at the -1% level right now. So you usually worry about 10-year yields, and when they move higher, the growth stocks, you've got to discount them at a higher rate. But with such a reflationary backdrop, I think you're going to more than compensate the higher discount rates with higher earnings that we expect in the second half of this year.
When we get to that trip point, not to walk through the math down, we don't do the math on radio and TV, but when we get to that trip point, do you see jump conditions in the market? Do you see great instability? Or is it something that the market can manage, the dawning of a positive real yield?
I really think you'd have to have such a strong growth backdrop for the markets to manage it. So it's possible. If you do have a very strong growth backdrop with very strong earnings growth and a real clear path to earnings growth where everyone expects that, I do think you can manage without negative real yields. But we're a long way from that. And every trade is so correlated right now because every trade is being driven by negative real yields, whether it's gold, Bitcoin, equity prices, property prices. All of these things are dependent on negative real yields, and the negative real yields push you into those things. So that's why they're correlated. Bonds and equities shouldn't be correlated when you think about it, but it's the negative real yields that are driving both prices.
Let's talk about nominal yields as well. At the ECB right now, there's a negative depot rate of -50 basis points, and I've spoken to a lot of people, Patrick, who just don't think that the ECB can get rates back to zero in the next cycle. So I'm trying to work out what that means for the bond curve. This morning, a 30-year auction with a yield just north of 0%. Patrick, how do you think about that? If the ECB can't get back to zero anytime soon, what does that mean for the bond curve?
It means a flat burn curve at best. It's hard to see how you get bonds back above zero until you have a prospect where you get depot rates at zero at least. And as you say, it's very difficult to do. We're going to be in a growth year for the Eurozone, definitely, but there's no inflationary pressures. You're getting inflationary pressures much more in emerging markets, much more in the U.S. because of the currencies depreciating in the U.S. The strong euro saps any hope for inflation in the Eurozone right now.
Given the fact that we are seeing this sort of split right now between the U.S. and the Eurozone that was not necessarily expected running into this year, we see the reflationary expectations in the U.S. outpacing those in Europe by the most on record, according to some measures. Are you piling on that trade, going into U.S. assets and avoiding the Eurozone completely?
We actually have more Eurozone assets than U.S. assets in our equities right now. In the currency, we're short dollar, long euro, just because that euro strength, you want to have assets that are denominated in euro if you do have the weakening dollar in a global context. So actually, even with that backdrop, I still think it favors a lot of euro-denominated assets.
And you're still doubling down on that, even though there is this sort of correlation these days between the strength of a currency and their vaccination schedule, which has favored the U.S.
Definitely, yeah. The U.S., even the U.K., surprisingly, have done very well on the vaccinations, better than expectations even from a couple of months ago. Europe and Canada way behind on that. So it probably doesn't bode well for the consumption and the services industry so much in Europe versus the U.S., but I think the manufacturing economy, which is Germany intensive, I suppose, that's driven by the global backdrop, and I still think that bodes very well for Germany.
Patrick, a number of our guests have talked up the healthcare sector as behind. Margie Patella, Wells Fargo Management, the legend in high yield, really pushing healthcare in a conversation yesterday. Is there an opportunity in healthcare out of this pandemic?
I think there is. I think you can make a case for Moderna that it's really risen sharply, but vaccines, I can see a very plausible scenario where they're with us for decades to come, where you have to, if you want to travel and have a travel passport, you've got to get vaccinated 2 times a year against all the new mutations, things like that. Novo Nordisk, a play on diabetes, and everyone's staying at home, not exercising as much. Diabetes was a massive problem, and I just think the pandemic has probably made that even worse.
Patrick, great to catch up. Patrick Armstrong of Plurimi Wealth Management there on the bond market, on the vaccine rollout as well, and the prospect of a vaccine passport. I think this was rolled out by Qantas, or at least pondered by Qantas, very early on, Tom, last year. Do you remember that, when they started to at least think about that? Maybe that is the future for airline travel.
Brilliant. And John, you were way out front on, can we just get JFK to Heathrow fixed? And we're nowhere near that.
We haven't. And I hope, Tom, maybe you can get a London-New York corridor open, given how well the UK and the United States is rolling this out. But what we've learned over the last couple of months is just the level of nervousness, anxiety that these governments have over these new strains. They seem to be much more comfortable allowing at some point later this year consumers domestically to re-engage with the economy, but keeping international travel shut.
You know, I do agree the new strains has really put a monkey wrench into this. I mean, there's no question about that. John, what I found great there, seriously, is about the real yield, is where is that trip point? I mean, I know that's going to be a theme of your new half hour, the real yield, but John, you wonder, where is that trip point on inflation-adjusted yield where things change? I don't know where it is.
What I think is interesting about the move in nominals so far this year, Tom, is it's not just been treasuries. And if you ask many people in fixed income, can you get a sell-off in treasuries in isolation, in a vacuum, or do you need the rest of the global bond market, core government bonds, to come with it? I think a lot of people will lean towards the latter. And what we've seen so far year to date is bunds play ball. Yields are up year to date by about 22 basis points. We've seen gilts play ball. I think the yield on a 10-year gilt has almost doubled, maybe even tripled at this point. The next question you have to ask yourself is, okay, if you need the rest of the core government bond market to come with treasuries, what are the limits of that? And I think we touched on that with Patrick just then. If you don't think the ECB can engineer a recovery that takes rates back to zero, what is the prospect of the 10-year bund selling off much more than it already has?
John, these are incredible mysteries, and one of the solutions here, folks, Friday afternoon is to get briefed for your weekend, and that has to be the extended 30-minute edition of Bloomberg Real Yield. John Farrell, 1 p.m. Friday.
I'm trying to work out what you've done to me this week. Now, I understand what you've already done, but I'm wondering whether there's something I don't know that you've done.
I'm just trying.
You know what I mean, Lisa?
Yeah,
is he making up for something that I don't know about yet?
Embrace it. I mean, come on.
I just think that at 10 Eastern, I'm going to walk off set and find out that Tom's done something
He'll toilet paper your desk.
You know, it's like something's happened to my desk.
Lisa and I are trying to get you to a 1-hour edition of the Real Yield.
Oh, so you cut me from this. So you cut me from this on a Fridays, and then I'll be on in the afternoon. Nice. Coming up, Jordan Rochester, Nomura, G10 FX strategist. This is Bloomberg.
With the First Word News, I'm Karina Mitchell. That deep freeze could keep parts of Texas in the dark for days. Power suppliers from Texas and North Dakota implemented rolling power cuts for a second day in a row. The operator of the Texas electric grid says it could be days before enough power plants are back up and running. On Tuesday night, outages spread to Arkansas, Louisiana, and Mississippi. Meanwhile, the U.S. and Japan reportedly have agreed to extend their agreement on troop funding for a year. According to the Asahi newspaper, the deal will keep Japan's share of the cost of hosting U.S. forces at about $1.9 billion a year. Former President Trump had demanded a fourfold increase in financial support. And obviously, there is no love lost between Donald Trump and Senate Republican leader Mitch McConnell. The former president blasted McConnell, calling him a dour political hack who was responsible for Republicans losing the Senate. Trump said the party can never be respected again as long as it has leaders like McConnell. After the Senate acquitted Mr. Trump in the impeachment trial, McConnell said the former president was responsible for the riot at the Capitol. And Ford plans to go almost entirely electric in Europe by the end of the decade. That's a major overhaul for the automaker. Ford didn't sell a fully electric vehicle on the continent last year. The company is putting $1 billion into a German factory that will start making an all-electric model in 2 years, playing catch-up there. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. There is much more to come. Stay with us. This is Bloomberg.
women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Let's just start with the numbers.
It would be essentially free cash flow positive in 2021. That was sooner than people had been expecting.
We have pretty good numbers here in the biggest divisions of Morgan Stanley. They are firing on all cylinders.
We've had this huge rivalry historically between Morgan Stanley and Goldman Sachs.
There are 24 reasons for Mr. Diamond to celebrate today.
As much as people may want to focus on trading, for Bank of America, it's all about credit.
It seems the markets are very happy with Trump. They're very happy with Biden.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
It is still needed for the world economy, in particular the US and Europe, to have a reflationary policy, expansionary policy. Monetary policy is going to remain very accommodative, and there will be time, I think, in 2-3 years to address inflationary pressures.
Lorenzo Bini-Smaghi there, SocGen's chairman from New York City this morning. Good morning to all. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Shape of the price action looks like this morning, 7:48 Eastern Time. Equities now positive, just about up 2 points on the S&P 500, 39.29. In the bond market, yields come in a couple of basis points after a little peak at life north of 130 at 129.73. Tom, that is where your 10-year still is. And euro dollar, some dollar strength this morning, Tom. That's the theme in G10. Euro dollar back to 120.64.
Bitcoin, West Texas Intermediate, $61 a barrel. That puts Brent crude, the global price, up at $65 a barrel. We got to look at that as well. Right now, this is fun. We've really been looking forward to this. Jordan Rochester with us with Nomura. He's out of the University of Warwick, and he's really, really quite good. Very acute research notes as well. Jordan, I want to go right to ADXY and your reaffirmation of Pacific Rim strength, whether it's Korean won. ADXY has been stuck like a wall through all of 2021. How does the Pacific Rim break out to stronger currencies this year?
Well, Tom, it is going to be a bit of a battle between the central banks who want to avoid having too much currency strength in the area. But also, we're in a global recovery, that reopening vaccine trade, Tom. It's very hard for those currencies not to appreciate, especially probably later this year when it becomes clearer that the Asia region gets a strong supply of vaccines. So right now, it's been mostly focused in Europe and the US, the developed market areas where we're getting that vaccine supply. By the latter half of this year, we could be talking about how Asia's vaccine pipeline has significantly improved. There's also the big programs about donating to developing markets as well from those developed markets. So that's going to be one of the factors. The other factor is just the rise in commodity prices means that some in Asia, the energy importers, are struggling here, and that oil price move will hurt certain countries. But there's also a massive demand for consumer home goods. That's a hangover from last year's 2020 trade. We had the whole inflows into China based on PPE, based on consumer goods. That trade's still going. I don't know about you, but you're still at home buying things off Amazon, and it's mostly imported from China during this shutdown. So when it comes to the Asian trade, I think that the CNH is going to be one of the leaders on this. So we're looking for dollar CNH to get to 625. We also like India. That's one of the strong trades that our team in Asia likes. And I think we've had a recent risk-off position reduction, essentially, in these markets. US yields going higher. Definitely, it's a bit of a short-term game changer. I don't think it's medium-term, but in the short term, a few people have to think again about the trades they have on, especially the sort of lazy long trades they've had since last year that have done very well.
This brings a tear to my eye. On radio, folks, only on Bloomberg surveillance can you get a 3 cross-rate Asian quote there, John, like the board we just put up. I mean, on radio, it's hard to see what rupee is doing, but there it is, John. It brings me to tears.
Well, you bring up the rupee. I just want to try and reconcile something, Jordan. You talked about the commodity currencies, and then you talked about some of the countries that would be suffering because of the commodity imports, and then you said you liked India. Can you just square that circle for me?
Well, there's an FDI story as well. So there's always a tug of war in foreign exchange, and this is the framework I advise people to think about when looking at trades. There's the trade flow, which is your sort of goods trade, your services trade, and then there's the financial flow. A very good trade is when both are in your favor, and in China, that's currently the case. In India, yes, it is tricky with rising commodity prices, but there's a financial FDI inflow story that's keeping it supported too. And guys, just take a step back. We're in a recovery, and historically in recoveries, high beta carry trades do very well. So that's going to be the financial flow that drives most of these currencies stronger for the next year. Bear that in mind. The trade flows always make it a bit tricky when it goes against you. So certain countries, that's the case. But I'm focused more on the financial flows in the very short term.
In the medium term, you raised some skepticism about whether this higher Treasury yield trade and stronger dollar could persist. What do you see in the near term, and can you square that with the consensus view heading into 2021 that the dollar would continue to weaken and that yields would continue to rise?
Absolutely. Great question. Medium term, long term, our forecasts are for dollar weakness. About 2 weeks ago, we went short the euro and we got burned. So we caught the break below 120, for example, and we caught some of that dollar strength. But we had a weak non-farm payrolls, and we had Janet Yellen coming out in support of the package that she and Biden are putting through. Therefore, we had higher US yields and so forth. It's been a bit of a mess in the G10 FX space against the dollar for the past couple of weeks. And I think the reason why is we're seeing position reduction. We're looking at our trend following what we call CTA model following signals. And right now we've reached levels where we're seeing treasuries go from maximum long to actually now selling. We're not yet at maximum short, so we're going to probably see a continued move in the yield space. So let's think US 10-year treasury at 1.5% by June or September. That is your funding cost going up. That makes your trades that you've had on for quite some time that have maybe been going sideways recently, force you to readjust and say, you know what, that trade's made 4 or 5%, it's not really going anywhere, and my cost of funding's rising, what's the next trade? And so we're seeing position reduction. And I think that's what's happening for the time being. We need to get to a place where US yields settle, then the dollar will stop strengthening like it is. That's the short term. Medium term, when you have we're thinking early March, when you have this bill go through, the fiscal package, $1.9 trillion, that's a lot of money with a lot of fiscal stimulus going all within a short period of time. It's going to be quite import intensive. You're going to see the trade balance of the US widen. You're going to see US net issuance widen. And then you might say, well, that's just one and done. But actually, we've got the infrastructure package, hopefully in September. That's another 1, 2, 3 trillion. We're not really sure what the number is. That's also going to lead to demand for commodities too. So the trade flows will really work against the dollar during that period. Financial flows, as I mentioned, they're currently working in the dollar's favor. But I think when we get to that period, there's going to be such significant outflows via the trade balance that it'll be very hard for the dollar to strengthen.
Jordan, before I let you go, this bit of the programme just for you and I, two boys from the Midlands. Leicester Villa this weekend, Sunday. What are you looking for, Jordan?
Look, we had a 1-0 against Arsenal the other day, pretty good, but Villa's, we got 2 games in hand, essentially. I think the Leeds game, in 2 games' time, we've got much more of a chance. Leicester, I've got low expectations, John, but hopeful, of course. It's one of the weirdest years for the Villa in terms of everyone can't actually go watch it in the stadium. It's one of our best years to go watch it. So it's been a bit of an interesting one. We're hoping for Europa, really, aren't we? Champions League seems still pretty tough for us by the end of the season, but fingers crossed, who knows?
Jordan, thank you.
It's been a funny year.
Do you hear that? That's the sound of the ratings just going whoosh.
I just, three people just drove off the road in the Pennsylvania I-80 there.
They're like, who's Villa?
John, would
and
you
who's
guys,
Leicester?
stop
and
the
where's
show.
the Midlands?
Would you guys explain which league is the one that's most prestigious? Americans are like, Premier League, FA Cup, World Cup. Which one matters?
Well, for the national teams, Tom, it's the World Cup. For the clubs, I would say it's the Champions League, which is the best of the best in Europe. And then at the domestic level is the Premier League. We've got to go. We've got 10 seconds. Jordan, thank you, sir. Jordan Rochester there of Nomura. From New York City, Nuria Rabini. Next on Bloomberg Surveillance.
What's the biggest mistake you made when you were a fresh MBA grad and looking for a job?
Make sure you try to do something that you're interested in and that you think you'll be good at. I just was on a path to law school, and I actually never asked myself why I wanted to go to law school. And I randomly went to an investment banking analyst recruiting event, and I figured out I had an aptitude for it. I was interested in the work. If you're not interested in it, and it's not something you're good at, the money will not justify it. I also think that there's nothing wrong with experimenting. Doing something that you always thought you might want to do, trying it for a couple of years, you can then go back down a traditional path if that's what you want to do. Try to remember what you want out of a job, where you want to live, what you want to get from it, from personal experiences, from development, from training, from fulfillment, from engagement in the community, and make sure you think about those things up front as you're recruiting and not try to evaluate it after you got there.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
cyclical elements will almost certainly show some uptick.
This market could really ramp up.
You've had an incredible level of churn in this economy.
The point is to unleash consumption.
This is going to be a global recovery if it happens, for the simple reason that it was a global recession.
The hope is that we see this unleashed pent-up demand lift us even higher.
It is inflation that will ultimately drive the shift in monetary and fiscal policy.
At the core of it, high yields are predicting faster growth.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. The sum of all the parts is simple. Take it right to the 10-year yield, 1.30%, just barely off the new surge. John Farrow, it is a surge in yields.
It's been a while, hasn't it? And we had a massive move in the last 24 hours, but it's not just treasuries, it's bunds too. But I think the headline this morning really told you about how bad things have been in the hunt for income. We had a 30-year issue from Germany this morning, just above 0%, Tom. And it's been about a year since we've seen that.
Huge demand for the Italian piece yesterday as well. We welcome all of you on our simulcast on Bloomberg Radio, on Bloomberg Television. Good morning to you across these 3 hours. Noah Rubini coming up on Bitcoin. John, I don't know if Rubini understands yet. Bitcoin well above 50,000.
I think Nouriel's seen that number, Tom, and I don't think Mr. Rubini has changed his views either. The professor joining us very shortly. But outside of treasuries, Tom, it has been a buy everything rally, hasn't it? Bitcoin, equities, credit, the periphery in Italy. You mentioned that bond auction, 10 billion euros comes to market, the order book, 110 billion.
Yeah. Lisa, to your reading, is this bond surge, is it the kind of thing we saw in 2006, 2007, this insatiable adjustment in bonds?
Well, the interesting thing, and we've been talking about this throughout the morning, that it hasn't led to a tightening in financial conditions. And there's this irony baked into markets right now. What is safe and what is risky, given the fact that you've got the safest of instruments, these securities that are losing value rapidly, while the riskier debt, the riskier assets continue to fly high.
John, I want you to help me with a data check here. I've got the VIX 21.18. Dow futures are fractionally higher. Who cares? I'm looking at Brent crude, John, with almost a 65 print as well. What do you see?
Close to 61 on WTI. Tom, I'm just struggling to get used to seeing it. A 10-year at 130.
Yes, I agree
130,
totally.
40. And I know it has been a long, long time. And I get it that some people might sit here and say 5, 10 years ago that was unthinkable, that we'd be this low. I have to say in the last 12 months, it's unthinkable to see it this high again. 130.40 is where we are, Tom, in a basis point on a session.
Well, that's where we are. Every second counts here. Let's get right to it in this 8 o'clock hour on Wall Street. We welcome all of you again. For Noah Rubini, there are any number of topics to spend a long conversation with Professor Rubini at NYU Stern School and, of course, NorielToday.com. But his comments the last time he appeared with us on Bitcoin, those comments went worldwide. We get an update, $10,000 higher on Bitcoin. Nouriel, let's just start with the simple microeconomics, the supply, the demand. Why is Bitcoin surging?
My view is surging because there is a massive amount of manipulation. There are pump and dump schemes. There is spoofing, there is wash trading, there is front running, there's the issuance by Tether of a fiat currency not backed by much, that's used to manipulate the price of Bitcoin. I think it's a bubble. Fundamentally, Bitcoin is not a currency, it's not a unit of account, it's not a scalable means of payment, it's not a stable store of value. Not even Bitcoin conferences accept it as a means of payment because the price volatility implies that your profit margin can be wiped out. And it's not even a single numeraire. You know, the Flintstones had a better monetary system than Bitcoin because they had the shells instead of having a different token for different purchase of goods and services. So these are not currencies. Calling them cryptocurrencies is a misnomer. They're not even assets.
Nouriel, I want to get to the heart of it, and I'm going to go to Raphael Hours' path-breaking work with Benoit Carré at the Bank of International Settlements. The transaction costs of Bitcoin in retail transactions preclude its use. So do you look at Tesla as a one-off and that Bitcoin just simply will never be used at retail because the transaction costs are so much higher than normal currency?
Well, the transaction costs are huge, but the technology, proof of work, doesn't allow more than 5 transactions per second. The Visa network allows you 24,000 transactions per second. So it's not a scalable means of payment, leaving aside the fact that transaction costs are so high, it's never going to be used for goods and services. It's just used for speculation and buying other cryptocurrencies. So it's a self-serving system, but it's not something that's going to be used as scalable means of payment for goods and services ever.
Nouriel, you mentioned the volume of transactions. What about just a smaller volume but in larger size?
Meaning what?
Meaning if you could transact in large sums of money and move cash through Bitcoin from one country to another in large numbers. So not the volume of individual transactions, but let's say you could move $1 billion from point A to point B with Bitcoin.
Well, you know, even Steve Mnuchin said that we cannot have crypto and Bitcoin becoming the next Swiss bank account being used by human traffickers, terrorists, tax evaders as a way of sheltering their wealth and moving across borders. Right now, across borders, there are slow movements of transactions because there is a KYC, there's MAL, there's compliance. That's why it's hard to move money from one country to another. That's why there are capital controls. So if you have a system that is illegal that allows you to transfer money instantaneously from a country to another one without any control, of course, that something is going to be used by criminals or terrorists or human traffickers or tax evaders. But no system, no country is going to allow that. There's been a crackdown of the G20 on those types of offshore financial centers. There'll be a similar crackdown against the total lack of MAL and KYC in anything that's crypto.
So, Professor, what do you make of the increased institutional buying that we've seen more recently?
Well, you know, I think that you have to ask yourself, is this as an asset? It's not a currency, it's not even an asset. Usually stocks, bonds, loans, real estate give you some income, dividend, coupon, interest, or rent. Some other assets like residential real estate give you use, housing services. Gold doesn't have any income, but there's a use in industry, as utility, as jewelry, and has a past monetary use as a store of value. You look at Bitcoin, it doesn't have any income, it doesn't have any use, it doesn't have any utility, so it's a pure speculative, self-fulfilling bubble on price appreciation. It's like tulip mania. But in case of tulip mania, at least tulips had some utility. Even today, people love flowers. In this case, you have an asset that is not an asset because it doesn't have any feature of an asset. It doesn't have any feature of a currency, so it's just a self-fulfilling bubble. That's what it is. Its intrinsic value is zero, and actually, given it's hog so much energy for producing it, more than Argentina, if you had a pure carbon tax, the value would be negative, not even zero.
Well, some people would argue, Nouriel, that the idea of so much money flooding the financial system, that there is value in being able to put it somewhere and not lose money, that basically not being charged a negative yield is value in and of itself in this NERP, this negative interest rate policy world that we're living in. If this is a bubble, can it burst, given where we are with the liquidity spigots, without many other parts of financial markets also suffering big blows?
Well, you know, if it's a hedge against inflation, debasement of fiat currencies, or a collapse of the dollar, you would see a spike in tips in the price of gold, in inflation expectation. Yeah, eventually this monetary policy may lead us to those kind of outcomes, but the price of other assets will be sharply increasing. Gold went up 50% in the last 2 years, has now corrected a little bit. Why would Bitcoin go from 5,000 earlier last year to something like 50,000, 10 times higher, just because there's a hedge against some tail risk of that sort? Other assets will be pricing in. So that's not the explanation of the rise in Bitcoin prices. It's price manipulation of one sort of another. And Bitcoin is not even a hedge against tail risk. During the February-March episode last year, when you had a collapse in US and global equity of 30–40%, Bitcoin went down by 50%, and other cryptocurrency went down by 60%. So when there is risk off, they're not even hedged against those tail risks. So they don't have any hedging purpose of that sort either.
You say there's price manipulation. Who's doing the manipulating? I will get my words out. Manipulating.
Well, there have been tons of articles showing that there are these pump and dump schemes that are all over Telegram, groups that essentially are pumping and dumping the price of it. We know that Tether issuance is literally $1 billion every other day out of nowhere. No one has been verifying the account of Tether, and it's being used essentially to buy Bitcoin, and is not backed by anything. And there is a whole bunch of wash trading or spoofing. There are exchanges that are front-running their own clients. It's all over the map. I mean, stuff that is just should be investigated and is being investigated. There are a whole bunch of investigation by the DOJ, CFTC, the New York Attorney General Office of Tether and Bitfinex. They're undergoing right now.
Nouriel, what should governments do? I mean, there's got to be a point where in the United Kingdom, the city, the Chancellor of the Exchequer or some FSA body steps in, same in the United States and same in other nations as well. With your government experience with the Clinton administration, how can governments be constructive with the surge in Bitcoin?
Well, you have to enforce anti-money laundering and know your customer KYC rules. That's the first thing. There was a proposal by the Trump administration to make sure that unhosted wallets have to reveal who's behind them. That rule has not yet gone into effect. There are lots of things you can do. There could be investigation of whether there is price manipulation. There are investigations right now about Tether and Bitfinex. Those things have to continue because this is a bubble, and eventually it's reaching now a market value crypto of $1.4 trillion. And when there's going to be a bloodbath, like in 2018, when the price of Bitcoin went initially from 1,000 to 20, and then collapsed from 20 down to 3, at that time, the market value was very small, a couple $100 billion. Right now is a multiple of that. So the consequences and the losses for people are going to be so much severe for institutions and for retail suckers of one sort or another.
Nouriel, comment, please. And of course, and we thanks all of you out on Twitter and your emails watching Professor Rubini here on television and radio as well. Nouriel, people are transfixed by this debate. Explain to us not the thermodynamics, but the proof of work of electricity and its artificiality. How do you see the electrical consumption to make this machine go?
Well, Bitcoin alone, it uses the energy of a medium-sized country like Argentina, because instead of having, like in any legacy financial system, a few trusted individuals or institutions that are validating transactions to make sure there is no double spend, a bunch of banks. Now you have literally hundreds of thousands of bot miners who have to do a stupid cryptographic exercise so that one of them wins the task of verifying those transactions, and they're put on a ledger in hundreds of thousands of other computers. It's the most inefficient way of essentially verifying transactions. It doesn't make any sense. And by the way, it's not decentralized either, because 70% of all the mining of crypto or Bitcoin is being done by 5 or 6 oligopolist firms that are based where? In Russia, Belarus, and China. There are countries that have no rule of law. And we have a national security problem right now if we're relying on a bunch of miners in countries that are our strategic rivals, in which there is no rule of law to verify those transactions. So people talk about decentralization. It's not a decentralized system. You have centralization of mining, there's centralization of exchanges, where 99% of all transactions are occurring, there's centralization of developers, and centralization of wealth. The Gini coefficient for Bitcoin is worse than the one of North Korea, where Kim Jong-un and his family and cronies own the entire country. It's 0.86, while in Korea it's 0.84. It's just a total lie that this is a decentralized system. It's centralized, where a bunch of insiders and whales and others are controlling the entire system and are manipulating it in states in which there is no rule of law. It's just pathetic.
Professor, hopefully next time you come back, you can tell us what you really think about Bitcoin. Professor, it's good to see you. Nouriel Roubini, Professor of Economics at NYU Stern School of Business. I'd love to get Nouriel back with someone on the other side of this trade, Tom, just to have that debate.
Well, or to get somebody on the trade, and I think it would be Scott Minerd would be our candidate. I think Scott Minerd would be great talking about Bitcoin to 400,000 here, and much of it based around, John, the hope of Bitcoin being used every day in transactions.
We've got to turn to some economic data, Tom, in about 17 minutes' time. I believe, what do we have? Retail sales, PPI, in the United States of America. That's the main focus now.
Yeah, you know, to be honest, and I go to ECO Go here, folks, in our studios of the terminal, and the basic idea is retail sales is important, John, and that control group is just critical. You wonder, can you piece together a 3-month moving average in a pandemic?
Coming up on the program later in the hour, Michael Gapin, Barclays chief U.S. economist, weighing in on the situation in the U.S. economy, with equity futures just pushing a little bit higher, 39.28.25. The story's in the bond market, isn't it? 131 on a U.S. 10-year.
Stunning.
There it is, unchanged on the session after a big move in the last 24 hours. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro. Heard on Bloomberg Radio, seen on Bloomberg TV. Your economic data 15 minutes away in America. This is Bloomberg.
With the First Word News, I'm Karina Mitchell. Utility operators struggling with that deep freeze in Texas have a warning. Those rolling blackouts could keep parts of the state in darkness for days. Power cuts were implemented for a second day in a row to help prevent the collapse of electric networks. Outages spread last night to more states, including Arkansas, Louisiana, and Mississippi. Meanwhile, total U.S. oil production has plunged by the most ever because of the unprecedented cold blast. Traders and industry executives say crude output is down by about a third. In America's biggest oil field, the Permian Basin in Texas, production has plummeted by as much as 65%. President Biden plans to recalibrate relations with Saudi Arabia and will emphasize ties with King Salman. It's the latest sign the administration is taking a different track from Donald Trump. The administration will downgrade relations with Crown Prince Mohammed bin Salman, the country's de facto ruler. The U.S. has already put a hold on some key weapons sales to the Saudis. And another day, yet another record high for Bitcoin, as we've been discussing, the world's largest cryptocurrency scaling another peak, rising almost 6% to break the 51,000 level. Bitcoin has risen fivefold in the last year. Activity in Bitcoin futures suggests traders don't see a sudden end to the crypto rally anytime soon. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. There is much more to come. Please stay with us. This is Bloomberg.
Also lost here the biggest outage in the history of U.S. oil and gas. I mean, this thing is, we have never seen a loss of this scale at a time when, you're in midwinter.
Paul Sankey of Sankey Research, founder and lead analyst from New York City this morning. Good morning. Talking up $80 crude, Tom.
Yeah.
Jeff Curry at Goldman Sachs in the same ballpark. JP Morgan flirting with the idea. This is not their base case, but at least flirting with the idea of maybe seeing triple-digit crude again.
By the time we get you to the real yield on Friday, John, you may have a 150 10-year yield the way we're moving. I mean, these are markets, again, on odd tape, John.
But to be clear here, Tom, you said a couple of things like this so far this year, and I've laughed. I remember when you said, are we going to see 3,900 soon, 3,950?
Yeah, you made fun of me. He trashed me.
And then we got there. I'm happy to concede. And then we got there, 3,930, 3,950 briefly yesterday. And you mentioned a 10-year, Tom. It's happened really quickly.
Yeah.
130, well, just like that.
Tom, entry point out of the triple leverage cash fund?
Oh, no.
When does the 10-year start
with
the cash pile over at Kazakhin?
I'm thinking $80 on oil. Maybe I'll look at it. West Texas Intermediate. We're not there yet. Let's do this. We've just come off, and thank you so much for the comments that we've seen on the Rubini interview, particularly John and Jerry, and great that you're listening and watching us this morning. Michael McGlone joins us with Bloomberg Intelligence. I mean, a guy like John and Jerry and a great savvy derivatives option guy is going Nouriel's nuts. Discuss that divide between people pro-Bitcoin and someone as educated and as articulate as Professor Rubini saying you're nuts. Frame that divide.
Well, I think it's a big difference between someone like John, who's a trader, and someone who's an academic.
Well said.
And that's a big difference. I remember being on a trading desk and the economists would come out and give us a big piece of bearish news on bonds, and I'd say, well, I'm buying them. Why? Because it's already priced in. From an economist standpoint, I think he's missing a key thing about Bitcoin, and that is it's not a currency. It's a global reserve asset, a digital asset in a world that's going digital. And you can see the flows. It's happening. It's just accelerating. So as a strategist, I said, something's got to change. Flows are coming from gold. That's clear. From bonds. That's clear. And now from the stock market, i.e. Tesla. How are you going to stop that? I don't know. The point is, Bitcoin is far from, and people say it's too volatile. I'm like, yes, it's too volatile. It's not a reserve asset, yet it's getting there. So give it 4 years. And I see volatility on Bitcoin dropping below that of gold. If you follow the simple trajectory, a regression analysis of 260-day moving average. And the key difference is Bitcoin's supply is fixed, unlike gold, which both supply and demand are unknown.
Mike, what would you say to Nouriel Roubini's point that there isn't some sort of intrinsic value to Bitcoin? Such as, for example, with gold, you can actually make stuff with it. And other assets, you can actually get income from it, say if it's a property and you can rent it out. What would you say to that?
I think he's missing a key point of history. Now, I understand, is Turkish. And I recall in the history of conquest, there's people like Alexander the Great and the conquistadors and the Nazis. The first thing they would seize is the firm's gold, the country's gold. You can't seize Bitcoin. So in the world going digital, the people who've held gold forever are going that way. I look at the British Museum and things like the hoards, the Hoxne hoards. You had gold. That's all you had. Now you have Bitcoin. Now you have alternatives, sure, but it's already been adopted on a global scale. I think that's what he's missing. You don't use it for transacting. It's a collectible. You hold on to it, but the #1 traded digital currency in the world is Tether. It's a digital dollar, and that's what's happening in the ecosystem. Tether trades double the volume of Bitcoin.
All right, so can you give us a sense, Mike? One thing that you're so good at is having lots of conversations with people in the market who are interested in getting into different asset classes. Can you give us a sense of the scale of interest in Bitcoin among the institutional investors you speak with?
So I get it from everywhere, most notably like economic teams of major banks. They say the quote is, our clients are looking at it. Now, that is a known. We hear it every day about different entities and institutions and BNY Mellon having the custodian. But the key thing that you have to look forward to in markets is always something to look forward to. And in Bitcoin, there will be a U.S. ETF or ETFs. It's a matter of time until they get launched, until we have some of that $30 trillion of this U.S. wealth money going into Bitcoin. The price is more likely to go up.
Mike, you touched on something important. We've heard that a million times. We're looking at it because our clients are looking at it, and if our clients want to buy it, then we should buy it for them. Something else has shifted, I think, just in terms of portfolio construction. Are you hearing more and more PMs start to think about this as an asset to diversify into? And I'm not talking about 5–10% of the portfolio, just a little bit here and there.
Exactly. And the risk is reputation risk is now tilted against the naysayers. Let's say 5–10 years from now, and Bitcoin just continues to do what it's doing, and that is really capturing the world as a global reserve asset that's been, that's started organically. The people say nay are going to be at risk that they didn't get their clients in this. It's say 1% of their portfolio, and 10 years can easily be well over up 100x.
I talked to Professor Roubini about the transaction costs of affecting Bitcoin in the banking system versus Visa, MasterCard, and everything else my house uses. When do the transaction costs come down? There's
second layer solutions for Bitcoin.
What does that mean?
Called Lightning, where you can transact Bitcoin.
Michael, you got to understand, I thought Tether was a dating service. Okay? I mean, I'm dumb on this. Explain to me how the transaction costs on Bitcoin come down to be competitive in retail.
Most of the people who are buying now don't plan on selling. And that's the key thing about Bitcoin. It's a store of value. It's like Warren Buffett says about a stock. I plan on never selling it. That is the way I look at Bitcoin. Yes, it might get expensive, and yes, it might take a few hours to get out of it, but it's much easier than gold. It's more liquid, and you can do it on your phone. Millennials like that. Remember, this is a transition
if I have
to the
Bitcoin,
future.
I can sell it on the phone.
Yeah, right now, in PayPal, you can easily do that. Now, that's what's happening is people are looking at the past. Let's look forward. All these second layer solutions. One is Lightning, where you can transact on-chain, but then there's also things off-chain that are just happening. MasterCard's allowing it. It's on PayPal. It's going to Venmo. It's just
John,
something has to slow that down.
What do you think, John?
I just want to get a final word in on crude, if that's okay. Mike, before you go, WTI, almost with a 61 handle. What's going on?
Short-term spike usually makes long-term peaks. Reminds me of September 2019. Remember we had that attack on Saudi oil assets?
Interesting.
Very similar. This is not a permanent reduction in supply. It's going to come right back. The cold spell will move up. Remember, we're almost in March, and in a few months we're going to be worrying about heat in Texas.
Mike McClone, Bloomberg's very own. Thank you, sir. Mike, good to see you. Really, really good to see you. Not exactly endorsing that $80 crude call, is he?
No, I didn't get a lot of love there. I didn't see it, John. John, where are you on Bitcoin?
What is
Tether for a dating service?
I thought Tether was a dating service. What can I say?
Okay. 6 minutes away, some real data on the economy side, retail data, PPI. And I think on the factory gate side, just to tie this into what's happening in the commodity market, increasingly that's going to be a focus, Tom. The prices pushing higher at the factory gate. PPI data just a couple of minutes away.
Well, it's good. I mean, we're pushing away, John, from the deflation spiral of last week.
Of last week?
He's he's throwing shade at me, right? The idea that the people were then talking about deflation, and people seem to be pricing out the concept of deflation completely, and the reflationary trade is gaining steam. Do we see it in the numbers yet?
I mean, you may just see a churning of price.
No, but we know what's going to happen here. The base effects start to kick in. It's pretty obvious. Just look at the base effects from where we are going to where we were 12 months previously. Think about that on a rolling basis, and it's pretty inevitable that CPI starts to push higher.
Yeah, I would suggest the markets adjust for the base effects. They don't look there. There's other things to look at.
So.
John, I hate to say it, but I'm going to go back to the real yield. Very constructive, a negative 0.94. That's a big change from 10 days ago.
Very constructive for some of the valuations out there, that's for sure.
Let's do a show about it.
I'm not sure what's going on this show. Never mind that other show.
Lisa's getting her own show to compete with you and the real yield. It's going to be called the deflation spiral.
It would be highly competitive, I'm sure.
The deflation spiral.
Coming up next, I might not be here, but you will get some retail data and some PPI data as well. And then after that, you'll hear from Michael Gapin, the Barclays chief US economist. I might have already gone to the other studio for the next show. This is Bloomberg.
I think what we're seeing during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
economic data just around the corner in America from New York City this morning. Good morning to you all. Alongside Tom Keene and Lisa Abramis, I'm Jonathan Ferro, live on Bloomberg TV and radio. This is Bloomberg Surveillance. Equity futures coming in about half a point, basically unchanged on the S&P 500. A nice slate of economic data just dropping. Here's Mike McKee.
Good morning to you, John. Well, PPI, everybody's keeping an eye on inflation these days. Heard you guys talking about it in the last segment. 1.3%, that is a significant jump from the 0.3% in the prior month. This is for January. Ex-food and energy, it is up 1.2% now. That's important. We want to also check out the ex-food, energy, and trade, 1.2%. So big jumps, even if you take out gasoline and energy prices that have gone up significantly. Also, food prices have as well. So we do seem to have some pressures at the lower end of the economic scale, and we'll continue to watch that. Let's take a look now at retail sales. Retail sales up on the month by 5.3%. This was expected, but not that much. The forecast was for a 1.1% gain. You had a number of things happening during the month. First of all, some seasonals. We'd had a terrible year last year, and the seasonals suggest that there may be some overcompensation. The other thing is you got those $600 checks that went out, so people actually spending some money. Taking a look at where the money was spent, we're looking at I want to look at gasoline stations. Gasoline stations up 4% on the month, and that's a price change. We know gasoline prices went up, but electronics and appliance stores up 14.7%. Remember, the narrative in December was people stopped buying all the stuff for home offices. Looks like we went out and bought some stuff. Building material up 4.6% on the month. Food and beverage stores up 2.4%. So solid gains pretty much everywhere across the board. Non-store retailers up 11%.
Okay, we're going to go longer here. This is important. Mike McKee, dive into the data. John, I want to go to you on the data right now. Let's rip up the script here because we've got markets moving on what Mike McKee's talking about.
Yeah, Tom, here's the number, 133 on a US 10-year, 132.94. Overnight yesterday evening, we saw 133.10. We're getting back to those levels now. Yields were coming in. Now they're higher on the session by about a basis point. What comes with it? Stronger US dollar. Just short of 91 on the DXY, the dollar index 90.94. We're up about 0.5%. And if you want to really put all this together and get to the equity market as well, we come in just a little bit off the back of this. We're down about 7 points on the S&P 500, off by 0.2%. But I think the move that gets your attention, yields higher, pushing 133 again on 10s, and in the FX market, a bit of strength comes through, Tom. On a day where the dollar was stronger anyway, we add some weight to that move, 19.94 on the DXY.
Right. Mike McKee, do you take a 3-month moving average here? These are stunning numbers. 1 month, you're going to tell me doesn't matter. So how does a pro like you massage this retail of America?
Well, I think what you have to do is take an average and also discount the fact that this is all pandemic influenced. You look at clothing and retail stores up 5% in December, in January from December, but on a 3-month average basis, they're down 14.2%. They're down 0.8%. 14.2% was last year when we had the big drop. Food services and drinking up 6.9%.
Did you expect that?
Yes. We know your social life, so no, we didn't expect that because that's why John stuck around so he could participate here.
He went to the Faro School of Charm. I mean, John. I mean, it's everywhere.
I wrote him a check before he came on set.
But we had the big shutdowns in January. A lot of places shut down, a lot of food and drinking establishments shut down, but we saw a rebound instead. But the question that's going to come out of this is how much of this is the $600 checks? How much of this is the extra money that people got that was spent immediately? So we're going to have to watch another month or two to see how this goes.
We're going to go to Michael Gabin, but Mike McKee, I got one more question for you that's just critical. Can this change Fed policy in that it shows a more sustained 5 or 6% GDP statistic, which upsets their plan?
No, not at this point. The Fed is going to look past this as well because of these questions about how much of this is influenced by stimulus and how much of this is going to be lasting.
Okay, well, right now, this is wonderful, folks. Yeah, this kind of, the charts say it all on radio. All you need to know is a balloon out to 132, 133 on the 10-year yield. Michael Gapin joins some Barclays right now. Michael, does this kind of data solidify a Barclays call for buoyant economic growth?
It certainly does help. At least we're looking for growth to be very solid this year. And I think what this tells you is when fiscal stimulus or fiscal aid, I think is the better word, arrives to household balance sheets, it does get turned around fairly quickly and materializes in economic activity. So this is largely, we think, attributable to the $900+ billion aid package that was passed at the end of last year. We suspect we will be getting around a $1.4, $1.5 trillion aid package by the middle to the end of March. So I think this means we should see a pretty rapid acceleration in demand and household spending as we move into the second quarter, which could be continued if vaccinations continue apace and mobility gradually recovers over time. So yes, Tom, it does, I think, confirm our expectations about growth for this year, at least initially. Obviously, there's 11 more months to go.
Well, Michael, can you connect retail sales and sort of a 1-month pop after passing this stimulus plan to longer-term growth? How neat is that line?
I wouldn't say it's entirely neat, but so there are certainly a list of things that have to happen, including vaccinations and getting on top of the pandemic and perhaps turning to an economic recovery package later this year. But I think it does show you that when households have resources to spend, they ultimately will. So I think this does also address the question of excess saving on household balance sheets and what's going to happen to that excess saving if we can gradually normalize activity. There's one school of thought that says it's wealth. It's not really going to support consumption all that much. The wealth effect is diminished. Our view is that we think a lot of it is pent-up demand or at least deferred consumption that's likely to come back and support activity.
Just to give you an update briefly on this price action. The move didn't hold. It didn't stick. We faked just a little bit. 131.41 on 10s, pushed 133 about 5-10 minutes ago. On the dollar index, 19.91, just off the highs of a session of 90.94. Michael, we're talking about retail sales here, but maybe we should pay a little bit more attention to PPI. Factory gate prices are starting to push up. We're starting to see this in China as well. And I'm trying to understand, you've got this commodity boom, you've got these supply chain issues, PPI starting to bleed higher. How do you take the read on PPI out to CPI, Michael? How consistent is that read across?
Well, I think, first of all, we should note this is not just a U.S. phenomenon. You mentioned China. Across the globe, the PMI data in January said prices paid, the input prices are moving higher. Now, we think on net, this affects the emerging market, say central bank policy position much more because they're much more export-oriented. They have a heavier focus on goods production. In the U.S. and in Europe and most of the developed world, we're still more of a services-oriented economy. So how does it pass through to CPI? Probably further buoyancy in goods prices. Now, services really take the weight off of that, and so we think goods prices are still offset by disinflation and shelter or in services, at least for much of this year. So I think there will be a pass-through. I don't think it's going to affect, say, the Fed's view on how policy should be set, but it is kind of moving the needle a bit on central banks like in Brazil and South Africa, thinking about maybe we need to delay, or maybe we delay further cuts, or maybe we need to move to a tighter policy stance. So it's a global phenomenon right now. We don't think it affects the developed market world as much as the emerging market.
Is it more than just base effects, though, Michael?
Yes, I think it's clearly supply constraints. It's lack of availability of labor. It's lack of inputs. It's the lack of containers. We're not moving as much cargo via air. We need them versus containers. We know what's happened on shipping prices there. I just think the cost of getting goods where they're needed globally has risen. So I think it's more than base effects. Presumably, or we expect it will diminish over the course of the year if the composition of activity shifts back in the direction of services. But in the meantime, I think it's going to be with us for at least the first half of this year.
Getting increasingly complex to get a read on this. Michael, it's great to catch up, sir. Thank you. Michael Gapin of Barclays. And to Michael's point, Tom, it's not just a US story, it's a global story. Look out for what's happening at the factory gate in China as well.
Yeah, I totally agree with that. But John, I just did a fancy moving average study while you were going on the control group of retail sales. And I mean, it's just visible as all get out on the moving averages that you have a lift in inflation there, given the massive gyration since March.
And Michael McKee mentioned the checks sent out. Lisa, there will be more checks sent out in the near future, presumably.
What's interesting to me is that this is a huge beat from expectations. The market didn't hold the move. What matters to this market? I mean, yes, we're getting this inflationary push that we're seeing, but is this all priced in? At what point is it not, John?
Elisa, when are you satisfied? We had a move of, what, 10, 11 basis points on 10s yesterday?
You know,
I'm just pointing out, but it's not hold on a second. No, but I'm saying it's not correlated to the actual data.
Okay.
People are pricing it in, and then there's confirmation. But at what point will the data actually be a driving factor at this point?
In 1 week, we've gone 19 basis points on the 10-year yield. I know this because I am at Terminal Central here.
It's not enough. It's not
enough for Lisa.
I'm pointing out
that
the beats are no
spiral.
longer the drivers, and it's partly because of what you guys are talking about, how noisy and how messy, how hard it has been to get a read on this economy. I'm just pointing that out.
Wake Lisa up when we get 150 on a US 10-year. Then she'll be with us. 150.
Then I'll be with you on what?
Well, then you'll get that nice correction in the risk assets that you think we should have. Credit spreads maybe a little bit wider. Equities come in, NASDAQ lower.
Well, that was the move off of this, right? That was the immediate move. The knee-jerk move was the NASDAQ actually lower more than the others because that was the more rate-sensitive stocks, which we'll be talking about coming up with Gina Martin next.
I will be talking about that too with Richard Bernstein Advisors Deputy CIO, Dan Suzuki.
Love him.
Comes up in the next hour. I love him too.
Yeah, Dan Suzuki's great. John, very important as a data check here. Again, the 30-year bond, 2.07%. It's 2 below zero in Fargo, John.
1995 on a dollar index. We're back to session highs.
I know.
I like your new data check, Tom.
4 below zero.
We should add that into the fourth line there. You can do futures, FX.
2 below zero in Fargo.
I lived that
and
line.
And the temperature in Fargo. That's the new data check on Bloomberg Surveillance. From New York City this morning, a very good morning to you all. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Karina Mitchell. Well, that deep freeze could keep parts of Texas in the dark for days. Power suppliers from Texas to North Dakota implemented rolling power cuts for the second day in a row. The operator of the Texas electric grid says it could be days before enough power plants are up and running. On Tuesday night, outages spread to Arkansas, Louisiana, and Mississippi. Meanwhile, the U.S. and Japan reportedly have agreed to extend their agreement on troop funding for another year. According to the Asahi newspaper, the deal will keep Japan's share of the cost of hosting U.S. forces at about $1.9 billion for the year. Former President Trump had demanded a fourfold increase in financial support. And apparently there is no love lost between Donald Trump and Senate Republican leader Mitch McConnell. The former president blasted McConnell in a statement, calling him a dour political hack who was responsible for Republicans losing the Senate. Mr. Trump said the party can never be respected again as long as it has leaders like McConnell. After the Senate acquitted Trump in the impeachment trial, McConnell said the 45th president was responsible for the riot at the Capitol. And it was another blockbuster quarter for Shopify. Canada's most valuable company beat forecasts on sales and earnings, and it expects revenue to grow rapidly this year. A measure of product sales flowing through Shopify's platform was up a whopping 99% from a year earlier. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. There is much more ahead. Stay with us. This is Bloomberg.
a very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast, and it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being in almost opening the economy as much as one can.
We should not be too quick.
Okay, guys, stop on profit for euro on 120.40.5, yeah? For other people who just joined our channel, I'm placing a stop on profit from the position I had hold it for several days, 120.42.5. You can see it on the ticker. If you will go back to our trading sessions previous last week, you will find where I purchased this pair. So basically you will find out how long I've been holding it. The good thing that basically I don't have to pay anything. Broker pays me because we sold short this position, right? So okay, we're already in profit on euro against United States dollar. For all of you guys who follow trade and enter this position, it's time for you to place a stop on profit. Okay? Speak to you later.
On that marginal bit of risk on leverage, time is your friend here, and leverage is your enemy, and because leverage is uncontrollable.
Ken Mollison, where we are in investment banking and also in M&A. They're the chairman and CEO, of course, of Mollison Company as well. Lisa Abramowitz and Tom Keene off a bang-up retail report with yields higher, 132 on the 10-year. Lisa, I rarely do this, but I've got to go to Neil Dutta, who's a congenital optimist, who on Lincoln's birthday was pounding the table saying, watch what we do with our Visa and our MasterCards. It was up, and away, and Dutta nailed this strong retail report.
Yeah, he said that it was going to be perhaps more than 5 times as much as expected, and bang on, it was more than 5 times as big as expected when you look at those retail sales gains. Key question is, how do you extrapolate this out? Is this a one-time bang, or is this going to be something that has longer legs in the market that hasn't even been fully priced in yet, Tom?
Let's extrapolate right now. Our chief strategist for extrapolation at Bloomberg Intelligence, Gina Martin-Adams, joins us right now. Gina, I want to go from where we are now to June 30, which means we have an earnings season August 1st, the first week of August, the second week of August. Are we pricing in how American companies will do for the second week of August earnings season?
It doesn't appear that we are just yet. And I say that because we did appear to price much better than anticipated fourth quarter earnings. We're seeing that in price reactions for the fourth quarter. But we were completely unprepared for the degree of positive guidance and upward revision momentum that has emerged out of the fourth quarter earnings season. As companies are continuing to guide us toward much more positive conditions emerging in 2021 than any analyst had anticipated, it is having a very, very strong positive price effect. In our work, we can find a case to see earnings grow much greater than the consensus is expecting in 2021. Just based upon what we've seen throughout fourth quarter earnings so far. So I would suggest we've started to price better news for 2021, but we've got a long way to go to anticipate true idyllic conditions, which I think is what you're alluding to.
If that takes away the gloom call on stocks, does it lead you to a range on stocks because we've moved so far off of November 6, or can you actually see high single-digit blended advances?
You can continue to see advances in our mind as long as rates don't get out of control and as long as upward momentum continues in the estimate revisions. I mean, those are the two things that are absolutely driving stock prices, is this lower for longer idea with respect to interest rates, which certainly keeps interest rates lower, improving the value of those discounted cash flows in the future. And then also the fact that estimate revisions continue to move higher is certainly a positive input for price. So if you see one of those two things change, then you could see stock prices absolutely move into some sort of range consolidation, maybe even deteriorate somewhat. But neither of those two things is changing. Even the reports this morning, PPI less than 1%. I mean, you look 10 years ago, coming out of the 2009 recession, we got to 7 before it became problematic on PPI. So we're still in the very, very early stages of recovery, gathering some momentum, and that momentum is reflected in the upward price movement in the equity markets.
What counts as out of control for interest rates?
Yeah, well, it's certainly significantly higher than where we are today. I mean, if you think about the yield curve, for example, the yield curve spread was double where it is today by the time we started reaching equity market tops coming out of that 2009 recession, by the time we started reaching sort of a major turning point in the optimism that emerged in 2009. If you look at long-term interest rates, again, more than double levels of where we are today. So I think out of control is substantially higher than we are today. Right now, we're in this phase of the economy and the earnings recovery that is higher rates are still very, very positive for stocks. You've got to get to a point where inflation is significantly faster, where hiring conditions are driving much, much higher wage costs for companies before you deplete the earnings momentum via the inflation outlook.
Gina, I think a lot of people would agree with you that they don't really see many paths down to some sort of bear market in the near term. There is a question, though, whether there are pockets of froth, and Charles Cantor of Neuberger Berman came on a program earlier in the morning, and he said he's having the best opportunities, seeing some of the best opportunities in his career when it comes to shorting certain specific companies. Do you think that that is true based on what you're seeing, this sort of global sort of lack of enthusiasm for a rally that you see being sustained?
Yeah, I think that you've always got pockets of opportunity for shorts in the equity market. I mean, what we practice as strategists is sort of capturing the bigger trends, where you want to be sector positioned, where you want to be factor positioned, and the like. Without a doubt, we developed something of a bubble in defensive, high-quality stocks over the course of 2020. That bubble has been deflating over the course of the last 6 months and will probably continue to deflate somewhat into 2021. There are absolutely concentrations in specific stocks. Certainly a lot of retail speculation in specific stocks was exhibited over the course of the last 6 weeks in particular. So there are always pockets, but the really bigger question is, will those pockets overwhelm the bigger trend? And I would say the bulk of the evidence suggests that's just not likely to be the case so far.
Gina, thank you. Gina Martin-Adams with us, trying to get out there. I'm trying to get us out, folks, a little bit away from Q1, get out into Q2 and the mysteries that we see out there. On the data front, Lisa, I mean, we can look at equities here a little bit soggy. I'm not going to make much of that. I agree with John, Lisa. I'm not used to a 131 on a 10-year yield. I mean, this is truly, I guess it's not new territory, but it's odd to say the least.
Well, it's odd, especially when you look at high-yield bonds that are yielding right now 3.89%. That spread getting narrower and narrower. Yeah, we're not to all-time tights between high-yield debt borrowing costs versus the Treasury yield. But this is a new paradigm, right? And companies can borrow real cheap. But how quick does it take for that to reverse, given the sensitivity to that benchmark
The other
yield?
thing is oil. I mean, Paul Sankey was brilliant, I thought, earlier today in our 3 hours, Lisa, on oil, and this raging debate about, like as Mike McGlone says, is it a one-off of Texas cold, Amarillo really cold this morning, or is it the permanence to it, whereas Sankey says we can begin to visit $80, we get to think about $80 oil?
Well, yeah, the concept of shortages in production, some of the hits that some of the shale producers just keep. This idea that we've gotten to peak oil and some of the big majors are reducing some of their production time. I do wonder, though, about the discipline of their carrying out those plans if oil prices go high enough for them to turn a big profit should they increase production.
You know, there's a lot of gung-ho here about what we're going to do on the power grid, and I really wonder. That was a good conversation with Jim Wright, Texas Railroad Commission, that we did yesterday. Lisa, on gold, help me. We've ignored it. $17.79 an ounce. I mean, you know, what do I do with gold? Do I load the boat? I don't know.
Yeah, people are trying to figure out, is it a hedge? Is it something that's correlated to equities? Is it Bitcoin?
Well, McGlone says it's going to Bitcoin.
Right, well, that's what some people say.
Lisa, it's 1 below 0 in Fargo. We're on a constructive trend. 4 below, 3 below, 2 below.
Man, it's getting hot.
1 below 0 in Fargo.
A different kind of cold from experience. Hard to breathe in that kind of weather.
Fargo, North Dakota, good morning to all of you. Stay warm as you can. The former Treasury Secretary, Rick Perry, coming up on Balance of Power.
Okay, guys, position closed on euro. Well done. All of you who placed trade, who followed my trades, you did it. You made a profit. So let's look for other chance and opportunity to enter the trade. If you're looking to use our strategy, you can find it on, if you can see, red colored ticker, and the address moving slowly on this ticker. All of our positions you can see on blue one. So if you can see, I can remove right now euro pair because we sold it and we made a profit. So we don't have euro anymore. We still have Japanese yen, and we just sold it, as you can see, Swissy. Just right here, I will show you. So I will calculate in our case how much we made, because we sold 3 positions. We sold 2 long position and 1 short position. After calculation, I'll let you know how much we made. But you guys, if you follow the trades, you made really good profit from these trades. Good.
These solar arrays that we're going to install are going to be about half the size of the existing solar arrays that we have on the International Space Station. But because of the advances in technology over the years, they're going to provide about twice the power in just half of the area that the existing solar arrays cover.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Valuations, particularly, sort of technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
From New York City for our audience worldwide, good morning, good morning. The countdown to the open starts right now with 30 minutes until the open in Bell. Equity futures down 12 on the S&P. Your 10-year yield having a little look at life above 130. Let's get straight to it. We begin with the big issue. Will rising yields spoil the risk rally?
It comes down to what the pace of the move is.
If bond yields were to continue rising,
Is that going to put at risk, the risk asset recovery?
That's what we're starting to see, and that puts all the more pressure on that earnings growth.
As long as earnings are moving more quickly than yields are rising, then stocks are going to be okay.
Macro foundational issue to this whole risk rally here.
A lot more treasury volatility.
A very significant rise in long-term interest rates in the United States.
It becomes somewhat problematic.
Would bring this bull run to a stop.
The Fed is going to be, really late to pull the punch bowl.
Unless the Federal Reserve intervenes.
The Fed clearly doesn't want to take away the punch bowl.
inflation expectations are rising.
It's going to get pretty hot.
The reaction of stocks to higher bond yields.
This push and pull is going to happen all year.
Let's bring in the Bloomberg team, Sarah Pontek and Mike McKee. Morning, Sarah.
Good morning. And this really is the key question. At what point do rising bond yields start to detract from the attractiveness of the stock market? Here's your state of play this morning, because the reflation trade is still in play after that better than expected retail sales and PPI data. Crude oil pushing higher, holding above $60 a barrel. Of course, the energy market, that's its own story there. At the same time, though, we have seen a fluctuation in nominal yields and in break-even inflation expectations. You look at your 10-year break-even inflation expectation, still holding near the highest since 2014, though, and your 10-year holding above 130. How foreign that seems after what we had seen this past year or so. But you do have to put this all into perspective, because a 10-year nominal yield at 130 is still very, very low. Compare this to the last decade, a period in which yields were already historically low, but higher than they are now, when the 10-year averaged about 2%, above 2% actually. And over that period of time, the S&P 500 still gave a total return of 260%. So stocks have done well when yields have been higher than they are now. Granted, there have been some tantrums, like the Christmas nightmare of late 2018, when we saw stocks sell off after the 10-year surpassed 3%. But at the same time, the argument can still be made that stocks still look attractive relative to bonds. One way, look at the Fed model, look at earnings risk premium. At the same time, you can also look at S&P dividend yields. The S&P 500 now sports a dividend yield of 1.5%. That's still higher than the 10-year at 1.3%, but granted, that gap is narrowing, and this is being watched very, very closely, John.
Sarah, thank you. Not just treasuries, bunds, 30-year bund auction a little bit earlier this morning with a yield north of 0%. The low of the move last year was negative 50 basis points on a German 30-year. Right now, 16 basis points. Still exceptionally low, but it's about where we've been, where we're going, and how quickly we've moved as well. Let's just get to the data. Mike, the data this morning, PPI, retail sales, upside surprise, upside surprise.
Yes, indeed. I mean, Sarah was saying good advice, take a breath, but you could hear everybody gasp on Wall Street. When retail sales especially came in up 5.3% in January, the expectation was for a 1.1% gain. And in the prior month, in December, we saw retail sales fall by 1%. Now, here's the story. I want to show this chart here. This is retail sales less gas. We know gasoline prices had gone up, but they were even stronger. If you take gasoline and cars out of it, 6.1%. Okay, but here's the story. Probably seasonals played a big role here, plus the $600 checks. When you look at the unadjusted sales numbers for December to January, you see a decline. When they seasonally adjust it, you see a rise. Now, department stores are a good example. Department stores were up 23.5% according to the report, but if you look at the unadjusted department store sales, they were down 41%. So does the market look through all of this? That's going to be an interesting question. The other question is, what are we doing about inflation? PPI comes in strong, and of course, this was not just energy. The PPI for final demand up 1.3%, strongest in some years, and this is a story of inflation across the board, because in almost every category we had strong gains. Now you can see there how it doesn't really feed into CPI. And then this last chart I wanted to show you is 9/15. We get the industrial production numbers. Manufacturing has been rising, and yet employment in manufacturing is not keeping pace, and that could have implications for the long run. Put this all into context, John, and you're talking about how does this play out in Washington with the stimulus program. The strong retail sales might tell you that it's going to be harder for Joe Biden to get it through, but if you look past the numbers, That's the question. Will Washington look past the numbers? There is still a lot of weakness out there.
Mike, they just look unfazed on the fiscal side and the monetary policy side. Is anyone going to be pushed away from the track they're on, from the data we're going to see?
Well, but the thing is, the markets have all decided that they are going to go through with this. So if we see any kind of backing off in Washington, that's going to have an impact on stocks and bonds.
And that's played into the high yields we've seen over the last couple of weeks. Mike, great to catch up, sir. Thank you. Your 10-year yield had a little look at 133 early this morning, yesterday evening as well. Right now, just north of 130 on a 10-year. Coming in on the session, actually, by almost a basis point. So are we ripe for a pullback? Canaccor's Tony Dwyer thinks we are, expecting a bumpier path to additional gains. He writes the following: we believe the market is ripe for a pullback, but our investment themes remain in place given historic excess liquidity fueling a synchronized global recovery. Tony joins us now for more. Tony, let's start on that pullback. How important is the move that we've seen in yields for that call?
And it would have been, if it wasn't the rise in yields, it would have been something else. It's a market that has been, see, we're always famous for trying to figure out the exact moment that a correction is going to happen. My job is really to highlight the environment or the conditions that are ripe for that kind of correction. And I think that has been fed into clearly by the the rise in the 10-year note yield for sure. But if it wasn't that, it would have been something else. This market is so overbought. The enthusiasm is so historic. And again, you're talking to the bullish guy, but we are replicating. I heard Gina a little bit earlier in Tom's show talking about how we may not be similar to 2010 in that yields were a lot higher before it became problematic. I would throw in there the extraordinary increase in the amount of debt means it takes a lesser rise in rates to become an issue for the economy or the markets.
You're a student of market history, though, Tony. You can identify when we're overextended. Those conditions can persist. Why can't they now?
They have been. Right. So you've got, we follow the National Association of Active Independent Managers Exposure Index. This is an index where they poll active money managers, both small and large, each week to find out what their exposure to the market is. It can range from levered short, minus 200% to levered long plus 200%. But the real range, John, is somewhere between 20 and 90. It's been over 100 consistently for over the course of the last month and a half. In addition, last week's reading was the third highest in its history. So the enthusiasm's there. And again, this is a tsunami of money. There's three levels of liquidity. There's monetary stimulus, there's fiscal stimulus, and then there's interest expense stimulus. How many people and companies have refied their debt and saved a ton of money on that and put that back to work? So I don't think you want to try and quote unquote bet on the downside. I think you want to be ready for it so you can attack it when it happens because of this historic excess liquidity coupled with a synchronized global recovery.
What do you do when everyone feels the same way, Tony? They're all waiting for that correction so they can buy it aggressively, and then the correction just never comes.
It's my favorite part, buddy. It always comes, right? We are so good at calling corrections healthy, natural, and normal until they happen. Yeah. A 4% drop has federal investigations into the market volatility. Right? So, it's always natural and normal until you're in it. But then do you have the conditions that are right for buying it? And of course, you need that excess liquidity, you need expectations for a global recovery, but you also need to, for us, to have a tactical oversold condition, like the September swoon last year, down 10%. Like the October whoosh, end of October whoosh, down 8%. It's those periods that it's hard as heck to buy it, but that's when you want to be more aggressive.
It's always easy money when someone else has made it very quickly, Tony, but at the time when you have to buy it, it's very, very difficult. Tony, I want to finish on this then. If you're looking for that correction, you want to buy it aggressively, where do you want to buy? What pockets of this market are you waiting for that pullback in?
Well, John, remember last summer we were on, and it was like people are throwing haymakers at me because I think that the cyclicals were the place to be, and I continue to believe that that's true. Again, they haven't. Here's the interesting narrative: they haven't acted well. In the last 2 months, we started calling for a chill zone in this economic recovery theme at the end of last November. Industrials have literally gone nowhere since then. So we think that as the market pulls back, it's actually the small over large, cyclical over defensive, emerging over developed. Those are going to be a theme for us, not just since last summer, but into a couple of years from now. This is going to be a really long, good global recovery fueled by liquidity.
Tony, you say they haven't acted well. Let's just pick up on that. The energy complex on the S&P 500, that sector's up almost 20% year to date. The financials have been
and most
ripping.
of that's in the last 2 weeks, John. So that came, clearly that's acted well in the last 2 weeks. But again, if you look at industrials and materials over the course of since the end of November, the relative underperformance has been so historic that you actually want to start adding to them on a relative basis.
The data
when they
speaks
get
for
this
itself.
oversold.
Tony, it's great to catch up, sir. As always, it's good to see you. Tony Dwyer there of Canaccord Genuity, thank you. In this equity market, about 20 minutes out from the opening bell, equity futures come in just a little bit. No drama this morning. Your 10-year yield north of 130. It did have a little look at 133 briefly this morning and yesterday evening as well. At the market desk with your movers, here's Abby.
John, well, we do have a bit of a risk-off tone relative to the futures, but starting out with what is working, that part of the trade you and Tony were just talking about, the energy complex. We've got lots of gains here for big E&P and some of the big oil, I should say, and some of the medium-sized E&P companies. This, of course, as oil is higher on this energy crisis. Another piece of it, though, at least for Chevron, up nearly 3%, is Warren Buffett's Berkshire Hathaway taking a stake. In fact, Berkshire Hathaway is taking in a stake, new stakes in Verizon and Marsh McLennan as well. So those stocks are popping in the pre-market on the news. It's another Berkshire pick. It always seems to help, especially Verizon there. Take a look at that, up 3.6%. As for what's really weighing on the market, though, John, you won't be surprised by this, given the fact that the NASDAQ 100 futures are underperforming. Big tech, Apple, under pressure as Warren Buffett is reducing Berkshire Hathaway's stake to about $120 billion, pretty large, but again, a reduction. And then Microsoft and Tesla going along as tech sells off, John.
Abby, thank you. Coming up on the program, just around the corner, President Biden reiterating the need for a sweeping relief plan to revitalize the U.S. economy. That conversation up next with Nuveen's Brian Nick. 20 minutes out, equity futures come in about 15 points on the S&P, north of 3,900, but down about 0.4% on the session. This is Bloomberg.
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas...
Okay, we calculated, you see, we sold everything, all three positions. Let me explain what's happened here. We have three positions. One long position we opened at 0.90069. Short position 0.906. Then we opened long position lower, second long position, and we was waiting until it will reach level 0.89640. In this case, long position on 0.90069 and 0.89206 will go to zero, because long position from 0.89 will give us a profit. Long position we bought at 0.969 will give us loss. Altogether will give us no profit, no loss, but still hold short position. This is what will give us profit. So based on this trading style, this way, we trade and we make profit. In our case, we made profit on short position, and this is how much we made. If you're interested to use this method, this style, you can get the strategy, and we provide also webinar once a week on Wednesday, and you can start trading as well, and you will not lose any money at all.
Ahead in terms of getting this $1.9 trillion stimulus package through as the crowning achievement, John, of the first 100 days of the Biden administration. But I was struck, and candidly, sources that I talked to were struck this morning by something that President Biden said last night on the CNN town hall as it relates to minimum wage, because he essentially left some wiggle room for lowering the $15 minimum wage that he wants to see included in this package. He said, quote, increase the minimum wage from $7.25 an hour between now and the year 2025 to $12 an hour to $13 an hour. You double someone's pay and the impact on businesses would be absolutely minimal, and it would grow GDP. $12 and $13 an hour is a lot different than $15 an hour. And he even said prior to that statement in the CNN town hall that he understands that small businesses are very concerned about what an immediate hike to $15 an hour would mean, especially when the economy is getting pummeled, especially small businesses are getting pummeled by forced closures as a result of the pandemic. So bottom line, that minimum wage piece of this stimulus puzzle is a bargaining chip for the Biden administration.
So, Kevin, just to be clear here, who is he compromising with within the party?
Centrist Democrats. And that's a great question, because they're bypassing Republicans in the Senate as well as in the House, because they want to get this done faster. And they feel that the best way to do that is to bypass Republicans in Congress. So centrist Democrats in some suburban districts, they know that an immediate hike to $15 an hour is not something that the local chambers of the commerce of the world would be able to adequately support. It has to be phased in, and he just said maybe $12, maybe $13 an hour.
Kev, good to catch up. Kevin Cerulli down in Washington, D.C. Thank you, sir. 13 minutes out from the opening bell, equity futures come in. Your bond market bid now yields in 2 basis points, just south of 130 on a 10-year, 1.294%. Newsweek's Brian Nick expecting labour markets and consumers to remain well supported by government policy, writing the following: hopes for a rapid return to societal norms combined with another massive dose of fiscal support have us revising up our GDP and earnings forecasts. Brian joins us now for more. Brian, great to catch up, sir. Good to see you. Let's just start right there. Put some numbers on that, on those forecasts.
Yeah, sure. Thanks for having me, Jonathan. I think we have to look at now a GDP forecast for the U.S. this year that's got a 6 handle on it. I think there's upside risk to that analysis. But right now, the consensus is somewhere more like 4.5% to 5%. That's a substantial miss of consensus, I think, compared to what we're shaping up to get. If we get the stimulus package with some of the good economic news we got this morning, industrial production numbers just came out for January, better than expected. Overall, the economy doing okay considering everything that's happening, and likely to do a whole lot better once we can get the pandemic behind us or largely contained. And that goes for a lot of the rest of the world too. So we wouldn't be surprised to see S&P 500 earnings. I mean, we've already seen upward revisions to 2021 estimates to 25%. We wouldn't be surprised at all to see that go higher, given the ability we've seen of companies to contain costs and to continue to grow top line through this very difficult period.
So it's a blinking contest with the Federal Reserve. Brian, do they blink?
I don't think they're going to. And I think the GDP can come without a lot of inflationary pressure. The key question here, when we're talking about the American Rescue Plan, we're talking about the overall amount of stimulus in the system, is do we have the right estimate of how big would be too big? And there's a really interesting argument happening among economists about the output gap and potential GDP. Essentially, if we're wrong about how fast the economy can grow without overheating, there's a lot of potential runway in front of us, even with $2 trillion or so of additional fiscal stimulus before we get to that overheating pattern. I think the Fed is really going to want to bend over backwards not to make any kind of hawkish turn in rhetoric or indeed in policy either before 2022. So I suspect we get through this year without any changes or any announced changes to quantitative easing. But certainly there's upside risk to the economy that presents some risk around the Fed having to act sooner.
Brian, weigh in on that debate if you can, please. How useful are estimates of the output gap?
Yeah, it's very hard because you're two things. The output gap and potential GDP shifts over time depending on demographics, but you also are basically unable to observe it directly, so you have to make a pretty good guess as to what it is. And if you think the output gap right now is 2 or 3%, then yes, the Biden stimulus is too big. But if you think it's larger than that, because we've been kind of marking down potential GDP to actual GDP. So if GDP grows slowly, we go, oh gosh, it looks like maybe the economy can only grow at 1.5 to 1.8% a year. But if we're wrong about that, then I think we have room to do a whole lot more on the fiscal side, and the monetary stimulus that's sort of side by side is not going to overheat things. I think one really interesting
new order came through. I'm placing an order to sell short Bitcoin. The price I'm looking to sell okay, the price I am looking to sell 51,000. $262. Okay. 51,262. This is what I'm looking to sell Bitcoin at this price. So let's wait and see how long it will take me to fill this order. Oh, right here. Okay, let's wait.
that didn't perform as well last year.
Brian, you raise a really important question. It's the spread between the economy and the financial world. Are you saying that we could have this situation where the economy actually starts to improve, the realized data looks a whole lot better, and this market has already seen the gains?
Yeah, a lot of the market gains from last year were on not only the better than expected economic performance coming out of the reopening, which was a global phenomenon, but also the vaccine news, which basically, by definition, is pulling forward good news about 2021 into 2020. So the rally you see in November and December of last year is really about good news in 2021. So you can't have that twice. And likewise, on monetary policy, the Fed can't convince the bond markets it's going to stay at zero for 5 years twice. It can only do that once. And we have this, flat but steepening yield curve, very low interest rates. That can continue to have a beneficial effect, but the effect of getting from, 2% on the 2-year to now, 0%, that can only happen once. So a lot of these things are, I think, more or less baked in. We really need to see, better earnings performance, which we think we're going to get. But that's going to be the thing that pushes up the index this year. And probably we end the year with valuations substantially lower than they were to start the year, even if the market is up.
Brian, brilliant to catch up. Brian Nick there of Nuveen, Chief Investment Strategist. Big upside surprises this morning. PPI, retail sales, industrial production out in the last 10 minutes, and bonds a bit. The back end is rallying. 30-year yields coming back in 4 basis points. Your 10-year comes back in 2 basis points. This after a big sell-off in yesterday's session. Up next, the analyst action you need to know. That'll be next in our morning calls with futures negative. This is Bloomberg.
it's extremely exciting for the university, for being a historically black college and university. It's just exciting for our engineers to actually be allowed to work for a large firm such as Boeing with such technologies that we can see the outcome.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Four or 5 minutes out from the opening bell, equity futures this morning, slightly negative, down 17. We're off by 0.4%. That's the price action. Let's get to some morning calls. A look at some of the analyst recommendations on Wall Street this morning. We begin with the first call of three, a call from Citi naming Amazon its favorite internet stock with a 37.50 price target. The analyst expecting shares to start outperforming after trading at a range the last several months. That stock negative 0.4. Your second call from Goldman, upgrading Planetids to a buy, $34 price target. The analyst highlighting solid quarterly results with guidance signaling significant revenue growth. And finally, Deutsche Bank raising its price target to square. Street high 330. The analyst expecting the recovery and additional fiscal stimulus to fuel further upside. That stock is negative 0.8%. Your opening bell's next.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment. The politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Trading revenues coming in better than expected. Everything. Cash, 1.4 trillion. One of the most notable aspects of this report that was stellar.
Look out below in the equity market. Take a look at the Nasdaq. Nasdaq futures off by 132, down by about 1%. The Russell also lower, negative, down by 1%, off by 22 points. So the S&P 500 softer, lighter, heading south, off by 0.5% to 39.07. That's the opening bow. Move in the bond market's been interesting. Take a look at this. A bid comes back in. Yields down by 3 basis points, but nicely through 130 overnight yesterday evening. This morning, though, the data beat. Upside surprise, upside surprise, upside surprise on retail sales, PPI, and then again, just about 15 minutes ago, on industrial production. Outside of the bond market, in the FX market, dollar strength is the story. Euro dollar 120.43, off by 0.5%, and we trim crude, a break of 60 again, 59.90, and off by about 0.25%. That's the cross asset story this Wednesday morning at the market desk with your movers. Here's Abby.
John, certainly a macro risk-off story that you were just showing there. Before we take a look at what's dragging in particular on the NASDAQ, let's start out with what's working. Of course, that is energy, despite the fact that crude oil is back below $60 a barrel. Chevron getting a nice bid, up 1.8%. This, of course, is Berkshire Hathaway has taken a stake, but also on this energy crisis. And then you have Antero Resources, a natural gas company higher, pipeline company, a refinery company. So all aspects of the energy complex in the green. As for what's not working, before turning to what's really in the red, the banks. We have the yield curve in, as you've been mentioning, the 10-year yield back below 1.3%. That's weighing on all of the big banks, including JP Morgan, Goldman Sachs, and Bank of America. So a little bit of a stall there for that part of the reflation rally. The big weight, though, is tech. Not surprisingly, with that NASDAQ 100 down about 1%. Apple, of course, was reduced by Berkshire Hathaway, down 1.2%. So perhaps setting the tone here for the tech complex, John, which, as you know, last year seen as the safety trade. But the bigger piece around tech, these trillion-dollar companies, this is really the big weighting to all of the major averages. So when you have these stocks down, you certainly feel it in spades, as we do on this morning, John.
Abby, thank you. Much more from Abigail through the next 30 minutes or so. About 90 seconds into the session, equities down 0.5% on the S&P. Bottom of the pile, information technology, as Abby indicated, down 0.9%. Top of the pile again. In fact, the only sector on my screen right now, out of the 12 that we take a look at, that's positive is energy. Energy up by about 1% on the S&P 500 after seeing gains of almost 20% so far this year to date. And I keep doing this. It's February 17th, year to date. February 17th, a move of almost 20%. Unreal. Let's stick on energy. Freezing temperatures spreading throughout the United States, sending crude prices to one-year highs and providing a spark for energy equities in a big way. For more, here's Sarah Ponzek.
Hey, John, it's quite amazing to see returns that you would expect over a period of years in just a couple of months into 2021. But that's exactly what we're seeing when it comes to energy. Energy just seems to be at the top of the pack day to day, and it is year to date. Granted, higher crude prices, of course, also adding a boon to energy equity prices in small caps and in large caps. Small cap energy stocks already up 46% in 2021. Large cap energy in the S&P 500 up close to 20%. There you see it right there. Now, an argument, though, for the energy catch-up trade has been that it's a catch-up trade, not just to other areas of the equity market, but also to the commodity itself. Because if you look at crude performance over the past year, WTI crude oil is now up about 15% over the past 12 months. You look at energy equities, though, in the S&P 500, still down about that much. So you still have a 30 percentage point gap. Some would point to that as reason for possibly a further catch-up trade there for energy equities, further room to run. But take a look at the equity markets, the credit markets, I should say, because still by no means are all energy companies out of the water. Some are still in deep troubles with demand still lagging from COVID-19 and the fallout there. If you look at high yield energy still trading at a premium of about 175 basis points to the high yield space X energy. And of course, equity holders are much further down the capital spectrum should some of these companies go bankrupt. And I'll just leave you with a fun fact for reference. Over the past year, about 20%, so about a fifth of companies that have gone bankrupt, John, well, they were in the energy space.
There we go. And that's been a story in high yield for a long time. Huge concentration in energy. Sarah, thank you. Looking at high yield spreads, 315. That's how tight we are now on high yield spreads. And that's exactly where we were. They were the tights of early 2020 going into the pandemic. And we are back at that number. And this economy still hasn't reopened in a significant way. Dan Suzuki of RB Advisors favouring cyclicals and small caps to offset rising interest rate risk. He writes the following: investors have the option to buy much cheaper assets and sectors like financials that benefit from rising rates. Small caps, value and deep cyclicals offer much more reasonable valuations and are likely to offer superior profit growth. Dan joins us now for more. So Dan, the lazy analysis that I conduct looks at the moves we've seen in the last 5 months or so and says, wow, off the back end of October, we're up, what, 20, 30, 40, 50% in some parts of this market that you like. Walk me through the valuation case, Dan.
Yeah, John, thanks. Great to be on your show again. I think that the numbers you're talking about are probably more a reflection of how far they fell, as opposed to how much room there is to run, right? The reason those numbers are so big is because they underperformed by so much as the economy was going into lockdown. So I think if you just look at relative to where we are today, relative to pre-pandemic levels, I think they're probably one of the few areas of the market where there is room for more runway in terms of those earnings upsides and getting back to pre-pandemic levels. So I think that's the valuation story. When the profit cycle is improving, you always want to own the stuff that's most geared to that improvement, and that's this deep cyclical stuff that we own.
So when people say that sentiment is extended, it's stretched, Dan, are you saying it's skewed to very specific parts of this market?
Yeah, so part of sentiment depends on your time horizon. A lot of what people are saying right now is that, the stuff that we like is a bit extended, and that may be true on a very short-term tactical trading basis, right? Those numbers that you're talking about represent some enormous gains over the last, 3, 4, 5 months. But I think when you take a step back and look at the long-term picture of flows and of sentiment, it's clear that that's not the stuff that's overowned right now. What is overowned and what is crowded and what is still blowing the cover off the ball in terms of the inflows is the same old, secular growth, disruption, and sexy innovation themes that have been leading the way for the last 10 years. And I think that's the opportunity and that's the risk in the market as well.
How sensitive is that part of the market to higher rates, Dan?
It's extremely sensitive. I mean, it depends, again, on what time period you look at, because there will be periods where, rates are moving higher and those stocks are still doing well. But I think if you look over a long-term perspective and you just think about the underlying fundamentals, I mean, by definition, they're very sensitive to rates, because these high growth, high multiple expensive stocks have a tremendous amount of growth embedded into them, right? That's what a high P multiple is. Another way of saying high P multiple is high long-term growth expectations for profits. And so by definition, a lot of your profits are 20, 30 years into the future that you're baking into those values. And that means that as interest rates go up, the value of those dollars, those future dollars, is less today, just by normal basic, finance math.
Does that make the index, the S&P 500, increasingly sensitive to rates also then, Dan?
Yeah, I think that's absolutely right. If you extend sort of the definition of technology and high growth and disruption, you can easily get to a number that makes up about 50% of the overall, S&P 500 as an example. So I think you're absolutely right there, John.
I will have to remove order to sell short Bitcoin because it moved fast. It moved away from the order I placed to sell short. Let's wait a little bit and see where it will go. And then I'll figure out what to do next.
Close to 40% in 2000, 2001. And so that's the opportunity, is that rotation within the markets.
Dan, you can't see this board. I want to get back to the most bullish forecast just quickly and bring up that visual element again for our audience. Just to go through this, the highest targets, 4,400, 4,300, 4,200. They're there for our audience to take a look at. Dan, are you saying that that's going to be really difficult to achieve if tech isn't leading?
I think that's probably true. I think it is difficult to see those gains, and it's not to say it's not possible. I just don't think that's where the big opportunity is. I mean, when you talk about the risk to the high flying, crowded parts of the market, I think there's two sort of risks to think about. The near term risk is that they just simply underperform because their earnings underperform, right? To their credit, they're going to put up pretty good numbers this year, but those numbers are going to get dwarfed by these deep cyclical sectors that are going to see growth in the neighborhood of 30, 40, 50, 60%, plus numbers. That's the near-term risk for their leadership. But the longer-term risk is that, if you just think about the next 10 years, they're unlikely to outperform simply because expectations are too high and the starting point valuations are too high. So I think that is the bigger concern. When you see that next profits rollover, which we don't see imminently, when we do see that, then there's a bigger concern for how much downside you can see in those parts of the market.
And Dan, final question for me. When you and I were catching up in the depths of the pandemic, coming out of that when we started to see the rally off the bottom, you were far more conservative about what would happen in the subsequent few months ahead. Why more constructive this time relative to where you were, say, at the back end of spring last year, going into summer?
Well, I think there's a few things into that. We focus on profits, liquidity, and sentiment. I would say that today, relative to back then, it's a completely different story. Back then, profits were plummeting and liquidity was tightening up, and sentiment was probably the only positive thing going for the markets back then. Today, it's almost the opposite, where we're probably going to see the biggest profit acceleration in a decade. Liquidity is literally off the charts today, and the one negative out there is sentiment and valuation, which is why we're trying to reduce our risk to those parts of the market where where sentiment and valuation are elevated. So I think it's just a very different story today than relative to February, March.
Dan Smart, it's been too long. Let's catch up soon. Dan Suzuki there of RB Advisors. Let's get back to the market desk and get you some movers. Here's Abby.
John, before digging into what's really weighing on the market this morning, let's start off with some idiosyncratic movers, because we do actually have a few stocks moving to the upside, having to do with individual stories to the stock. So MoneyGram, a 3.1% stake by Steve Cohen's 0.72, has this payments and money wiring company soaring up 11%. Verizon up nearly 3% on Berkshire Hathaway starting a position in the company. Hilton, on the other hand, down about 3%. They missed and they provided guidance that's disappointing. And Henry Schein, the dental company, not quite sure what's going on there. It looks like they beat. The stock, though, is plunging, so we'll be reporting on that throughout the day. Very quickly on the blockchain complex, we, of course, do have Bitcoin, perhaps some viewing that as a haven in today's risk-off tone, which is sort of hard to get my mind around. But nonetheless, here you have these blockchain and Bitcoin companies absolutely soaring, with Bitcoin nearly at $51,000 per Bitcoin. As for what is weighing, it has everything to do with big tech and the banks. Take a look at Apple, down 1.2%. Berkshire Hathaway reduced their stake to $120 billion. Perhaps some investors wondering, is this the sign that we're not so much at a top, but a sign that you have, the Oracle of Omaha reducing here. We see Tesla, a momentum stock, down, not for any particular reason that I can find on the tape. So again, an idea of edging out of these names. And then the banks taking a bit of a hit as yields come in and actually returning to Berkshire. JP Morgan, Berkshire Hathaway exited their stake on JP Morgan, so that could be something else weighing on that particular bank, John.
Abby, thank you. We'll touch base in just a moment. Coming up on the program, the US boosting its supply of vaccines, with hospitalizations tumbling over the past month. That conversation up next with BlackRock's Michael Fredericks. From New York City this morning, good morning. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
By next Christmas, I think we'll be in a very different circumstance, God willing, than we are today. I think a year from now, when it's 22 below zero here, a year from now, I think that there'll be significantly fewer people having to be socially distanced, have to wear masks.
By next Christmas, my producer Amy said that makes her want to cry. By next Christmas, that might be how long this takes. President Biden speaking at a Wisconsin town hall, revealing his timeline for a return to normalcy. For more, here's Kaylee Lyons. Hey, Kaylee.
Hey, John, Christmas feels incredibly far away, but the central message coming from the Biden administration is that more vaccines are coming. In that CNN town hall from Milwaukee last night, the president saying both Pfizer and Moderna have agreed to sell more doses of their vaccines faster than planned to the U.S. after he invoked the National Defense Production Act. Separately, the White House said yesterday the vaccine supply is increasing to 13.5 million doses per week. That's up from about 11 million. In his remarks last night, Biden also talked about reopening schools, predicting the country could be in a better place by September, so before Christmas, in time for the beginning of the school year. He expects to see a majority of elementary schools open by the summer. And he also signaled teachers should be closer to the front of the line for vaccines, though ultimately that decision is up to the states. As for where vaccinations stand right now, the older you are, the more likely it is that you've gotten yours. No surprise given the guidance that we were given, but 28% of the shots so far have gone to people over the age of 75, another quarter to those between 65 and 74, and then it goes down incrementally depending on the age bracket. In total, the average pace of daily vaccinations in the U.S. stands at a rate of around 1.7 million. I will note, though, that has hit a bit of a snag with the deep freeze in many parts of the country this week that has closed clinics. Power outages have made it harder to keep the vaccines cold, and the distribution of the supply has been delayed as well. Then looking at a global lens, vaccinations are ticking up, about 3.5 million inoculations given globally each day, but it is going slower in places like Europe where restrictive measures are still in place. France just today saying it is too early to reopen restaurants and bars. Sweden fleshing out tighter measures as well. So that divergence, both in terms of the vaccine trajectory and the virus trajectory between the U.S. and Europe, remains very, very wide, John.
Kelly, thank you very much. Isn't that the story? The U.S. versus Europe right now, and the rollout in Europe has just not been good at all. In the United States, to go through the numbers, 12.2% of the population has had at least one shot, 4.7% now are fully vaccinated, and the rollout, and the number that Katie used, 1.67 million, that's your average daily rate right now. That gives people some confidence that we can get back to normal quickly. Don't know about the Christmas line, but hopefully we can start to reopen, begin the process much, much sooner than that. BlackRock's Michael Fredericks remaining pro-risk. He writes the following: we're optimistic about global economic normalization. Equities still have upside potential, and the sectors that lagged in 2020 should play catch up as society gets back to normal. Michael joins us now over the phone. Michael, I just want to jump to this one line that just popped off the page for me. We continue to maintain the lowest duration spread, the lowest duration rather, than at any point in our flagship fund's 9-year history. You've really tightened up duration, Michael. How concerned are you about interest rate risk?
Well, I think we've seen some big moves already, obviously, and I'm pleased that we've had hedges on in our portfolios to protect against that. So. But I think, look, the path of rates going forward is likely higher, despite the big move that we've seen over the last several days or even year to date. So, I think the big question in my mind is how quickly do we adjust higher, because I think that'll have big implications for the way that equity markets react. But, stepping back for a minute, let's not forget that real rates, if you look at 10-year real yields, they've really not moved very much, and they're still deeply negative.